Are you ready to learn how America's most successful investors built their fortunes? Welcome to the audiobook of William J. O'Neill's classic investing guide, How to Make Money in Stocks, the 2001 edition that has stood the test of time. About the book. This isn't just another investing book. William O'Neill, founder of Investors Business Daily, reveals the proven can slim registered strategy, a blend of technical and fundamental analysis designed to help you pick winning stocks before they soar. Who should listen? Beginners who want to learn how the stock market really works, intermediate investors looking to sharpen their buying and selling strategies, students of finance and business who want a timeless, practical investing framework, entrepreneurs and professionals seeking to grow their wealth independently, anyone curious about the mindset, discipline, and methods behind successful investing. What you'll learn: how to identify market trends and ride them, when to buy a stock and when to sell, how to read charts like a pro, why most people lose money in the market, and how to avoid their mistakes. Whether you're investing $500 or $500,000, this audiobook will arm you with the tools and insights to make smarter, more confident investment decisions. So hit play, take notes, and let's dive into the strategy that's helped thousands build wealth in the stock market. Don't forget to like, subscribe, and comment below. Let us know how this book changes the way you think about investing.
How to Make Money in Stocks, A Winning System in Good Times or Bad, by William J. O'Neill. Part 1, A Winning System Can Slim. Introduction. You can learn and benefit from America's 100 years of super winners. After the market debacles of 2000 and 2008, most investors now know that they need to take charge and learn much more about what they're doing when they save and invest their hard-earned money. However, many investors don't know where to turn, whom to trust, or what they must stop doing if they are to achieve dramatically superior investment performance. You don't have to give your money to a Bernie Madoff, who'll take it but won't tell you exactly what he's doing with it. Instead, you can and should read a few good investment books, attend some investment classes, or participate in an investment meetup group so that you can learn how to invest with real confidence. At the very least, you should learn and understand the sound principles and proven rules and methods that will protect and build your investment portfolio over time. Half of all Americans save and invest. Now it's time to learn to do it intelligently with critical knowledge. When I started investing, I made most of the same mistakes you've probably made, but here's what I've learned. You should buy stocks when they're on the way up in price, not on the way down. And when you buy more, you do it only after the stock has risen from your purchase price, not after it has fallen below it. You buy stocks when they're nearer to their highs for the year, not when they've sunk so low that they look cheap. You buy higher-priced stocks rather than the lowest-priced stocks. You learn to always sell stocks quickly when you have a small loss rather than waiting and hoping they'll come back. You pay far less attention to a company's book value, dividends, or PE ratio, which for the last 100 years have had little predictive value in spotting America's most successful companies, and focus instead on more important proven factors such as profit growth, price and volume action, and whether the company is the #1 profit leader in its field with a superior product. You don't subscribe to a bunch of market newsletters or advisory services, and you don't let yourself be influenced by recommendations from analysts, who, after all, are just expressing personal opinions that can frequently be wrong. You also have to acquaint yourself with charts, an invaluable tool most professionals wouldn't do without but amateurs tend to dismiss as complicated or irrelevant. All these vital actions are completely contrary to human nature. In reality, the stock market is human nature and crowd psychology on daily display, plus the age-old law of supply and demand at work. Because these factors have remained the same over time, it is remarkable but true that chart patterns are just the same today as they were 50 years ago or 100 years ago. Few investors know or understand this. It can be to your inspiring advantage. In this 4th edition of How to Make Money in Stocks, I'm showing you right up front, in Chapter 1, 100 annotated color charts of 100 of America's greatest winning stocks, covering each decade from the 1880s to the end of 2008, from the Richmond and Danville Railroad in 1885 and Northern Pacific during the famous corner of the stock in 1901. When it raced from $115 to $700 in 1 week, to Apple and Google in our 21st century. There is a lot you can learn from studying these great examples. You'll see that there are such things as chart bases that have been repeated year after year with enormous success. There are 105 examples among the 100 stocks of classic bases that look like cups with handles when viewed from the side. Some are small, others large, and still others in between. In addition to cups with handles, we've identified 8 other distinctively different, highly successful base patterns that have occurred in cycle after cycle. Bethlehem Steel in 1915 is our first powerful high, tight flag example, and served as a perfect historical precedent for later high, tight flags such as Syntex, Rollins, Simmons Precision, Yahoo, and Taser. All of these stocks had huge price moves. Charts will help you tell the better stocks in general markets from the weaker, riskier stocks in markets that you must sidestep and avoid altogether. That's why I put all these examples in Chapter 1, with notes marked on the charts to help you learn a skill that could just change your whole life and let you live better and smarter. A good, clear picture is worth 1,000 words. These 100 examples are just a sample of what you've been missing. We have models of more than 1,000 great stock market winners over the last 100 years. It takes only 1 or 2 to make your year or your future. But you have to get serious and work at really learning and knowing what you're doing when you invest. You can do it if you really want to. You'll probably find this a whole new way of looking at America and its stock market. From the railroad to the auto and the airplane, from the radio and TV to computers, from jet airliners to space exploration, from massive discount stores to semiconductors and the internet, this country has shown rapid, unceasing growth. Living standards for the great majority of Americans have improved materially from what they were 150 or even 30 years ago. Yes, there will always be problems and everyone likes to criticize, but America's innovators, entrepreneurs, and inventors have been a major driving force behind its unparalleled growth. They have created the new industries, new technologies, new products, new services, and most of the jobs from which we all have benefited. Now it's up to you to learn how to intelligently take advantage of the relentless growth opportunities America's freedom makes possible, and that entrepreneurs keep presenting for everyone during every business cycle. In the following chapters, you will learn exactly how to pick big winners in the stock market and nail down the gains they produce. You will also learn how to substantially reduce your mistakes and losses. Many people who dabble in stocks either have mediocre results or lose money because of their lack of knowledge. But no one has to continue to lose money. You can definitely learn to invest wisely. This book will provide you with the investment understanding, skills, and methods you need if you are to become a more successful investor. I believe that most people in this country and throughout the free world, whether they are young or old and regardless of their profession, education, background, or economic position, should learn to save and invest in common stocks. This book isn't written for the elite, but for the millions of ordinary guys and gals everywhere who want a chance to be better off financially. You are never too old or too young to start investing intelligently. You can start small. If you're a typical working person or a beginning investor, you should know that it doesn't take a lot of money to start. You can begin with as little as $500 to $1,000 and add to it as you earn and save more money. I began with the purchase of just 5 shares of Procter & Gamble when I was only 21 and fresh out of school. Mike Webster is one of our in-house managers who also started small. In fact, Mike sold personal belongings, including his music CD collection, to raise cash for investing. Prior to managing money for the firm, he had a gain of over 1,000% in his personal account in 1999, a very unusual year. Steve Birch, another of our in-house money managers, started managing money earlier. He took advantage of the roaring bull market of the late 1990s and protected most of his gains by going mainly to cash in the bear market. Between 1998 and 2003, he had gained over 1,300%. Both Mike and Steve have had their rough years, but they've learned from their many mistakes, which we all make, and gone on to achieve significant performance. You live in a fantastic time of unlimited opportunity, an era of outstanding new ideas, emerging industries, and new frontiers. However, you have to read the rest of this book to learn how to recognize and take advantage of these amazing new situations. The opportunities are out there for everyone. You are now in a continually changing and hopefully improving new America. We lead the world in high technology, the internet, medical advancements, computer software, military capability, and innovative new entrepreneurial companies. The communist/socialist system and the concept of a centralized command economy are now relegated to the ash heap of history. They did not work. Our system of freedom and opportunity serves as a model of success for most countries in the world. Today, it's not enough for you to just work and earn a salary. To do the things you want to do, go the places you want to go, and have the things you want to have in your life, you absolutely must save and invest intelligently. The income from your investments and the net gains you can make will let you reach your goals and provide real security. This book can just change your whole life. No one can hold you back but yourself. Secret tip: the first step in learning how to pick big stock market winners is to examine leaders of the past, like those you're about to see, to learn the characteristics of the most successful stocks. From these observations, you will be able to recognize the types of price patterns these stocks developed just before their spectacular price advances. Other key factors you'll discover include what the quarterly earnings of these companies were at the time, what the annual earnings histories of these organizations had been in the prior 3 years, what amount of trading volume was present, what degree of relative strength there was in the prices of the stocks before their enormous success, and how many shares of common stock were outstanding in the capitalization of each company. You'll also learn many of the greatest winners had significant new products or new management, and many were tied to strong industry group moves caused by important changes occurring in an entire industry. It's easy to conduct this type of practical, common-sense analysis of all past successful leaders. I have already completed such a comprehensive study. In our historical analysis, we selected the greatest winning stocks in the stock market each year in terms of percentage increase for the year, spanning the past 125 years. We call the study the Model Book of Greatest Stock Market Winners. It's been expanded recently to cover stocks dating back to the 1880s. It now analyzes more than 1,000 of the biggest winning companies in recent market history in detail, super stocks such as Texas Instruments, whose price soared from $25 to $250 from January 1958 through May 1960. Xerox, which escalated from $160 to the equivalent of $1,340 between March 1963 and June 1966. Syntex, which leaped from $100 to $570 in only 6 months during the last half of 1963. Dome Petroleum and Prime Computer, which advanced 1,000% and 1,595%, respectively, in the 1978-1980 stock market. Limited Stores, which wildly excited lucky shareowners with a 3,500% increase between 1982 and 1987. Cisco Systems, which between October 1990 and March 2000 advanced from a split adjusted $0.10 to $82. Home Depot and Microsoft both increased more than 20 times during the 1980s and early 1990s. Home Depot was one of the all-time great performers, jumping 20-fold in less than 2 years from its initial public offering in September 1981, and then climbing another 10 times from 1988 to 1992. All of these companies offered exciting new entrepreneurial products and concepts. In total, we actually have 10 different model books that cover America's innovative and highly successful companies. Would you like to know the common characteristics and rules of success we discovered from this intensive study of all past stock market leaders? They're all covered in the next few chapters, and in a simple, easy-to-remember formula we have named CANSLIM. Each letter in the words CANSLIM stands for one of the 7 chief characteristics of these greatest winning stocks at their early developing stages, just before they made huge profits for their shareholders, and our country, companies, and employees all pay taxes, as well as helping to improve our standard of living. Write this formula down and repeat it several times so you won't forget it. The reason CANSLIM continues to work cycle after cycle is that it's based solely on the reality of how the stock market actually works rather than on our personal opinion or anyone else's, including Wall Street's. Furthermore, human nature at work in the market simply doesn't change. So CANSLIM does not get outmoded as fads, fashions, and economic cycles come and go. It will beat big egos and personal opinions every time. You can definitely learn how to pick winners in the stock market, and you can become part owner of the best companies in the world. So, let's get started right now. Here's a sneak preview of CANSLIM. C. Current quarterly earnings per share, the higher the better. A. Annual earnings increases, look for significant growth. N. New products, new management, new highs, buying at the right time. S. Supply and demand, shares outstanding plus big volume demand. L. Leader or laggard, which is your stock. I. Institutional sponsorship, follow the leaders. M. Market direction, how to determine it. Please begin immediately with Chapter 1. Go for it, you can do it. Chapter 1. The greatest stock picking secrets. Right up front in this latest revised edition, you'll see 100 charts of the greatest winners from 1880 through 2008. Study them carefully. You'll discover secret insights into how these companies set the stage for their spectacular price increases. Don't worry if you're a new investor and don't understand these charts at first. After all, every successful investor was a beginner at some point, and this book will show you how to spot key buying opportunities on the charts, as well as critical signals that a stock should be sold. To succeed, you need to learn sound, historically proven buy rules plus sell rules. As you study these charts, you'll see there are specific chart patterns that are repeated over and over again, whether in 1900 or 2000. This will give you a huge advantage once you learn to recognize these patterns that in effect tell you when a stock is under professional accumulation. It is the unique combination of your finding stocks with big increases in sales, earnings and return on equity, plus strong chart patterns revealing institutional buying that together will materially improve your stock selection and timing. The best professionals use charts. You too can learn this valuable skill. This book is about how America grows, and you can too. The American dream can be yours if you have the drive and desire and make up your mind to never give up on yourself or America. Chapter 2. How to read charts like a pro and improve your selection and timing. In the world of medicine, X-rays, MRI, and brain scans are pictures that doctors study to help them diagnose what's going on in the human body. X and ultrasound waves are recorded on paper or shown on TV like monitors to illustrate what's happening to the human heart. Similarly, maps are plotted and set to scale to help people understand exactly where they are and how to get to where they want to go. And seismic data are traced on charts to help geologists study which structures or patterns seem most likely to contain oil. In almost every field, there are tools available to help people evaluate current conditions correctly and receive accurate information. The same is true in investing. Economic indicators are plotted on graphs to assist in their interpretation. A stock's price and volume history are recorded on charts to help investors determine whether the stock is strong, healthy, and under accumulation, or whether it's weak and behaving abnormally. Would you allow a doctor to open you up and perform heart surgery if he had not utilized the critical necessary tools? Of course not. That would be just plain irresponsible. However, many investors do exactly that when they buy and sell stocks without first consulting stock charts. Just as doctors would be irresponsible not to use X-rays, CAT scans, and X on their patients, investors are just plain foolish if they don't learn to interpret the price and volume patterns found on stock charts. If nothing else, charts can tell you when a stock is not acting right and should be sold. Individual investors can lose a lot of money if they don't know how to recognize when a stock tops and starts into a significant correction, or if they have been depending on someone else who also doesn't know this. Chart reading basics. Charts record the factual price performance of thousands of stocks. Price changes are the result of daily supply and demand in the largest auction marketplace in the world. Investors who train themselves to decode price movements on charts properly have an enormous advantage over those who either refuse to learn, just don't know any better, or are a bit lazy. Would you fly in a plane without instruments, or take a long cross-country trip in your car without a road map? Charts are your investment roadmap. In fact, the distinguished economists Milton and Rose Friedman devoted the first 28 pages of their excellent book, Free to Choose, to the power of market facts and the unique ability of prices to provide important and accurate information to decision makers. Chart patterns, or bases, are simply areas of price correction and consolidation after an earlier price advance. Most of them, 80% to 90%, are created and formed as a result of corrections in the general market. The skill you need to learn in order to analyze these bases is how to diagnose whether the price and volume movements are normal or abnormal. Do they signal strength or weakness? Major advances occur off strong, recognizable price patterns, discussed later in this chapter. Failures can always be traced to bases that are faulty or too obvious to the typical investor. Fortunes are made every year by those who take the time to learn to interpret charts properly. Professionals who don't make use of charts are confessing their ignorance of highly valuable measurement and timing mechanisms. To further emphasize this point, I have seen many high-level investment professionals ultimately lose their jobs as a result of weak performance. When this happens, their poor records are often a direct result of not knowing very much about market action and chart reading. Universities that teach finance or investment courses and dismiss charts as irrelevant or unimportant are demonstrating their complete lack of knowledge and understanding of how the market really works and how the best professionals operate. As an individual investor, you too need to study and benefit from stock charts. It's not enough to buy a stock simply because it has good fundamental characteristics, like strong earnings and sales. In fact, no investor's business daily reader should ever buy a stock based solely on IBD's proprietary Smart Select ratings. A stock's chart must always be checked to determine whether the stock is in a proper position to buy, or whether it is the stock of a sound, leading company, but is too far extended in price above a solid basing area, and thus should temporarily be avoided. As the number of investors in the market has increased over recent years, simple price and volume charts have become more readily available. Investors' Business Daily subscribers have free access to 10,000 daily and weekly charts on the web at investors.com. Chart books and online chart services can help you follow hundreds and even thousands of stocks in a highly organized, time-saving way. Some are more advanced than others, offering both fundamental and technical data in addition to price and volume movement. Subscribe to one of the better chart services, and you'll have at your fingertips valuable information that is not easily available elsewhere. History repeats itself. Learn to use historical precedents as mentioned in the introduction, and as shown on the annotated charts of history's best winners in Chapter 1. Our system for selecting winning stocks is based on how the market actually operates, not on my or anyone else's personal opinions or academic theories. We analyzed the greatest winning stocks of the past and discovered they all had 7 common characteristics, which can be summarized in the 2 easy-to-remember words "can slim." We also discovered there were a number of successful price patterns and consolidation structures that repeated themselves over and over again. In the stock market, history repeats itself. This is because human nature doesn't change, neither does the law of supply and demand. Price patterns of the great stocks of the past can clearly serve as models for your future selections. There are several price patterns you'll want to look for when you're analyzing a stock for purchase. I'll also go over some signals to watch out for that indicate that a price pattern may be faulty and unsound. The most common chart pattern, cup with handle. One of the most important price patterns looks like a cup with a handle when the outline of the cup is viewed from the side. Cup patterns can last from 7 weeks to as long as 65 weeks, but most of them last for 3 to 6 months. The usual correction from the absolute peak, the top of the cup, to the low point, the bottom of the cup of this price pattern varies from around the 12% to 15% range to upwards of 33%. A strong price pattern of any type should always have a clear and definite price uptrend prior to the beginning of its base pattern. You should look for at least a 30% increase in price in the prior uptrend, together with improving relative strength and a very substantial increase in trading volume at some points in the prior uptrend. In most, but not all, cases, the bottom part of the cup should be rounded and give the appearance of a U rather than a very narrow V. This characteristic allows the stock time to proceed through a needed natural correction, with 2 or 3 final little weak spells around the lows of the cup. The U area is important because it scares out or wears out the remaining weak holders and takes other speculators' attention away from the stock. A more solid foundation of strong owners who are much less apt to sell during the next advance is thereby established. The accompanying chart from Daily Graphs Online Registered shows the daily price and volume movements for Apple Computer in February 2004. It's normal for growth stocks to create cup patterns during intermediate declines in the general market and to correct 1.5 to 2.5 times the market averages. Your best choices are generally stocks with base patterns that deteriorate the least during an intermediate market decline. Whether you're in a bull market or a bear market, stock downturns that exceed 2.5 times the market averages are usually too wide and loose and must be regarded with suspicion. Dozens of former high-tech leaders, such as JDS Uniphase, formed wide, loose, and deep cup patterns in the second and third quarters of 2000. These were almost all faulty, failure-prone patterns signaling that the stocks should have been avoided when they attempted to break out to new highs. A very small number of volatile leaders can plunge by as much as 40% or 50% in a bull market. Chart patterns that correct by more than this amount during bull markets have a higher rate of failure if they try to make new price highs and resume their advance. The reason? A downswing of over 50% from a peak to a low means that the stock must increase more than 100% from its low to get back to its old high. Historical research has shown that stocks that make new price highs after such huge moves tend to fail 5% to 15% beyond their breakout prices. Stocks that come straight off the bottom into new highs off cups can be more risky because they had no pullbacks. Sea Containers was a glowing exception. It descended about 50% during an intermediate decline in the 1975 bull market. It then formed a perfectly shaped cup with handle price structure and proceeded to increase 554% in the next 101 weeks. This stock, with its 54% earnings growth rate and its latest quarterly results up 192%, was one of several classic cup with handle stocks that I presented to Fidelity Research and Management in Boston during a monthly meeting in early June 1975. Upon seeing such big numbers, one of the portfolio managers was instantly interested. As you can see by this example, some patterns that have corrected 50% to 60% or more coming out of an intermediate bull market decline or a major bear market can succeed. See the charts for Sea Containers and the Limited. In these cases, the percent of decline is a function of the severity of the general market decline and the tremendous extent of the stock's prior price run-up. Basic characteristics of a cup's handle area. The formation of the handle area generally takes more than 1 or 2 weeks and has a downward price drift or shakeout, where the price drops below a prior low point in the handle made a few weeks earlier, usually near the end of its down drifting price movement. Volume may dry up noticeably near the lows in the handle's price pullback phase. During a bull market, volume in the majority of cases should not pick up during a correction in the handle, although there have been some exceptions. Although cups without handles have a somewhat higher failure rate, many stocks can advance successfully without forming a handle. Also, some of the more volatile technology names in 1999 formed handles of only 1 or 2 weeks before they began their major price advances. When handles do occur, they almost always form in the upper half of the overall base structure, as measured from the absolute peak of the entire base to the absolute low of the cup. The handle should also be above the stock's 10-week moving average price line. Handles that form in the lower half of an overall base or completely below the stock's 10-week line are weak and failure-prone. Demand up to that point has not been strong enough to enable the stock to recover more than half its prior decline. Additionally, handles that consistently wedge up, drift upward along their price lows, or just go straight sideways along their lows rather than drifting down, have a much higher probability of failing when they break out to new highs. This upward wedging behavior along low points in the handle doesn't let the stock undergo the needed shakeout or sharp price pullback after having advanced from the low of the base into the upper half of the pattern. This high-risk trait tends to occur in third or fourth stage bases, in laggard stock bases, or in very active market leaders that become too widely followed and therefore too obvious. You should beware of wedging handles. A price drop in a proper handle should be contained within 8% to 12% of its peak during bull markets, unless the stock forms a very large cup, as in the rather unusual case of Sea Containers in 1975. Downturns in handles that exceed this percentage during bull markets look wide and erratic, and in most cases are improper and risky. However, if you're in the last shakeout area of a bear market bottom, the unusual general market weakness will cause some handle areas to quickly decline around 20% to 30%, but the price pattern can still be sound if the general market then follows through on the upside, creating a new major uptrend. See Chapter 9, M equals market direction. Constructive patterns have tight price areas. There should also be at least some tight areas in the price patterns of stocks under accumulation. On a weekly chart, tightness is defined as small price variations from high to low for the week, with several consecutive weeks' prices closing unchanged or remarkably near the previous week's close. If the base pattern has a wide spread between the week's high and low points every week, it's been constantly in the market's eye and frequently will not succeed when it breaks out. However, amateur chartists typically will not notice the difference, and the stock can run up 5% to 15%, drawing in less discriminating traders before it breaks badly and fails. Find pivot points and watch volume percent change. When a stock forms a proper cup with handle chart pattern and then charges through an upside buy point, which Jesse Livermore referred to as the pivot point or line of least resistance, the day's volume should increase at least 40% to 50% above normal. During major breakouts, it's not uncommon for new market leaders to show volume spikes 200%, 500%, or 1,000% greater than the average daily volume. In almost all cases, it's professional institutional buying that causes the big, above-average volume increases in the better-priced, better-quality growth-oriented stocks at pivot breakouts. A full 95% of the general public is usually afraid to buy at such points because it's scary, and it seems risky, and rather absurd to buy stocks at their highest prices. Your objective isn't to buy at the cheapest price or near the low, but to begin buying at exactly the right time, when your chances for success are greatest. This means that you have to learn to wait for a stock to move up and trade at your buy point before you make an initial commitment. If you work and cannot watch the market constantly, small quote devices or quotes available on cell phones and websites will help you stay on top of potential breakout points. The winning individual investor waits to buy at these precise pivot points. This is where the real move generally starts and all the exciting action begins. If you try to buy before this point, you may be premature. In many cases, the stock will never get to its breakout point, but rather will stall or actually decrease in price. You want a stock to prove its strength to you before you invest in it. Also, if you buy at more than 5% to 10% past the precise buy point, you are buying late and will more than likely get caught in the next price correction. Your automatic 8% loss cutting rule, see Chapter 10, when you must sell and cut every loss without exception, will then force you to sell because the stock was extended in price and didn't have enough room to go through a perfectly normal sharp but minor correction. So don't get into the bad habit of chasing stocks up too high. Pivot buy points in correct chart base patterns are not typically based on a stock's old high price. Most of them occur at 5% to 10% below the prior peak. The peak price in the handle area is what determines most buy points, and this is almost always somewhat below the base's actual high. This is very important to remember. If you wait for an actual new high price, you will often buy too late. Sometimes you can get a slight head start by drawing a downtrend line from the overall pattern's absolute peak downward across the peak, where the stock begins building the handle. Then begin your purchase when the trend line is broken on the upside a few weeks later. However, you have to be right in your chart and stock analysis to get away with this. Look for volume dry-ups near the lows of a price pattern. Nearly all proper bases will show a dramatic drying up of volume for 1 or 2 weeks along the very low of the base pattern and in the low area or few last weeks of the handle. This means that all of the selling has been exhausted and there is very little stock coming into the marketplace. Healthy stocks that are under accumulation almost always show this symptom. The combination of tightness in prices, daily or weekly price closes being very near each other, and dried up volume at key points is generally quite constructive. Big volume clues are valuable. Another clue that is valuable to the trained chart specialist is the occurrence of big daily and weekly volume spikes. Microsoft is an example of an outstanding stock that flashed heavy accumulation just before a huge run-up. Weeks of advancing prices on heavy volume, followed in other weeks by extreme volume dry-ups, are also a very constructive sign. If you use a daily graphs online chart service in conjunction with the weekly graphs, you'll be able to see unusual trading activity that sometimes happens on only one day. The day Microsoft broke out at its 31.5 buy point, its volume was 545% above average, signaling really important institutional buying. It then had a 13-year bull run from a split adjusted 10 cents to $53.98. How's that for a big percentage move? Volume is a remarkable subject that is worthy of careful study. It can help you recognize whether a stock is under accumulation, institutional buying, or distribution, institutional selling. Once you acquire this skill, you won't have to rely on the personal opinions of analysts and supposed experts. Big volume at certain key points is indispensable. Volume is your best measure of supply and demand and institutional sponsorship, two vital ingredients in successful stock analysis. Learn how to use charts to time your purchases correctly. Making buys at the wrong time or worse, buying stocks that are not under accumulation or that have unsound, faulty price patterns is simply too costly. The next time you consider buying a stock, check its weekly volume. It's usually a constructive sign when the number of weeks that the stock closes up in price on above average weekly volume outnumbers the number of weeks that it closes down in price on above average volume while still in its chart base. A few normal size cups with handles. Texas Instruments, Apple, General Cable, and Precision Castparts were all similar size patterns in length and depth. Can you recognize the similarity between Apple and Precision Castparts? As you learn to do this with greater skill, you will in the future be able to spot many cup with handles just like these past winners. The value of market corrections. Since 80% to 90% of price patterns are created during periods of market corrections, you should never get discouraged and give up on the stock market's potential during intermediate-term sell-offs or short or prolonged bear markets. America always comes back because of its inventors and entrepreneurs, and the total freedom and unlimited opportunity that do not exist in communist or dictator-controlled countries. Bear markets can last as little as 3, 6, or 9 months, or as long as 2 or, in very rare cases, 3 years. If you follow the sell rules in this book carefully, you will sell and nail down most of your profits, cut short any losses, raise significant cash, and move off margin borrowed money in the early stages of each new bear market. See the success stories at the end of the book. In fact, Investors Business Daily conducted 4 surveys in late 2008 that indicated that about 60% of IBD subscribers used our rules to sell and raise cash in December 2007 or June 2008, and thereby preserved most of their capital prior to the more serious decline in late 2008 that resulted from the subprime loan debacle. Even if you sell out completely and move to cash, you never want to throw in the towel on stock investing because bear markets create new bases in new stocks, some of which could be the next cycle's 1,000% winners. You don't foolishly give up, all the greatest opportunities of a lifetime are setting up and may sooner or later be just around the corner. A bear market is the time to do a post-analysis of your prior decisions. Plot on daily or weekly charts exactly where you bought and sold all the stocks you traded in the past year. Study your decisions and write out some new rules that will let you avoid the mistakes you made in the past cycle. Then study several of the biggest winners that you missed or mishandled. Develop some rules to make sure that you buy the real leaders and handle them right in the next bull market cycle. They will be there, and this is the time to be watching for them as they begin to form bases. The question is whether you will be there with a carefully thought through game plan to totally capitalize on them. Other price patterns to look for. How to spot a saucer with handle price pattern. A saucer with handle is a price pattern similar to the cup with handle, except that the saucer part tends to stretch out over a longer period of time, making the pattern shallower. If the names cup with handle and saucer with handle sound unusual, consider that for years you have recognized and called certain constellations of stars the Big Dipper and the Little Dipper. Jack Eckerd in April 1967 was an example of the saucer with handle base. Recognizing a double bottom price pattern. A double bottom price pattern looks like the letter W. This pattern also doesn't occur quite as often as the cup with handle, but it still occurs frequently. It is usually important that the second bottom of the W match the price level low of the first bottom, or, as in almost all cases, clearly undercut it by 1 or 2 points, thereby creating a shakeout of weaker investors. Failure to undercut may create a faulty, more failure-prone, almost double bottom. Double bottoms may also have handles, although this is not essential. The depth and horizontal length of a double bottom are similar to those of the cup formation. The pivot buy point in a double bottom is located on the top right side of the W, where the stock is coming up after the second leg down. The pivot point should be equal in price to the top of the middle peak of the W, which should stop somewhere a little below the pattern's peak price. If the double bottom has a handle, then the peak price of the handle determines the pivot buy point. See the accompanying charts for Dome Petroleum, Price Co., and Cisco Systems for outstanding examples of double bottom price patterns found during 1977, 1982, and 1990. Some later examples are EMC, NVR, and eBay. For double bottom patterns, the following symbols apply: A equals beginning of base, B equals bottom of first leg, C equals middle of W that sets the buy point, D equals bottom of second leg. If the double bottom pattern has a handle, then E equals top of the handle sets the buy point, and F equals bottom of the handle. Definition of a flat base price structure. A flat base is another rewarding price structure. It is usually a second stage base that occurs after a stock has advanced 20% or more off a cup with handle, saucer with handle, or double bottom. The flat base moves straight sideways in a fairly tight price range for at least 5 or 6 weeks, and it does not correct more than 10% to 15%. Standard Oil of Ohio in May 1979, SmithKline in March 1978, and Dollar General in 1982 are good examples of flat bases. Pep Boys in March 1981 formed a longer flat base. If you miss a stock's initial breakout from a cup with handle, you should keep your eye on it. In time, it may form a flat base and give you a second opportunity to get on board. Here are a few more recent examples: Surgical Care Affiliates, CB Richard Ellis, and Decker's Outdoor. Here's a new base we've dubbed a square box. After moving up from a cup with handle or double bottom, this formation typically lasts from 4 to 7 weeks, doesn't correct too much, usually only 10% to 15%, and has a square, boxy look. I've noted this over recent years, but finally we've studied, measured, and classified it. Here are some examples: L'Oreal, Corvette, Texas Instruments, Home Depot, Dell, and Taro. High tight flags are rare. A high tight flag price pattern is rare, occurring in no more than a few stocks during a bull market. It begins with the stock moving generally 100% to 120% in a very short period of time, 4 to 8 weeks. It then corrects sideways no more than 10% to 25%, usually in 3, 4, or 5 weeks. This is the strongest of patterns, but it's also very risky and difficult to interpret correctly. Many stocks can skyrocket 200% or more off this formation. See the charts for Bethlehem Steel, May 1915, American Chain and Cable, October 1935, EL. Bruce, June 1958, Zenith, October 1958, Universal Controls, November 1958, Certain Teed, January 1961, Syntex, July 1963, Rollins, July 1964, Simmons Precision, November 1965. Acustaf, January 1995, Emulex, October 1999, JDS Uniphase, October 1999, Qualcomm, December 1999, Taser International, November 2003, and Google, September 2004. Each earlier pattern serves as a precedent for each later pattern, so study them carefully. The E.L. Bruce pattern in the second quarter of 1958, at around $50, provided a perfect chart pattern precedent for the Certain Teed advance that occurred in 1961. Certain Teed, in turn, became the chart model that I used to buy my first super winner, Syntex, in July 1963. What is a base on top of a base? During the latter stages of a bear market, a seemingly negative condition flags what may be aggressive new leadership in the new bull phase. I call this unusual case a base on top of a base. What happens is that a powerful stock breaks out of its base and advances, but is unable to increase a normal 20% to 30% because the general market begins another leg down. The stock therefore pulls back in price and builds a second back and forth price consolidation area just on top of its previous base while the general market averages keep making new lows. When the bearish phase in the overall market ends, as it always does at some point, this stock is apt to be one of the first to emerge at a new high en route to a huge gain. It's like a spring that is being held down by the pressure of a heavy object. Once the object, in this case, a bear market, is removed, the spring is free to do what it wanted to do all along. This is another example of why it's foolhardy to get upset and emotional with the market or lose your confidence. The next big race could be just a few months away. Two of our institutional services firms' best ideas in 1978, M/Calm and Boeing, showed base on top of a base patterns. One advanced 180%, the other 950%. Ascend Communications and Oracle were other examples of a base on top of a base. After breaking out at the bear market bottom of December 1994, Ascend bolted almost 1,500% in 17 months. Oracle repeated the same base on base pattern in October 1999 and zoomed nearly 300%. Coming out of the Depression in 1934, Coca-Cola did the same thing. Ascending bases. Ascending bases, like flat bases, occur midway along a move-up after a stock has broken out of a cup with handle or double bottom base. They have three pullbacks of from 10% to 20%, with each low point during the sell-off in price being higher than the preceding one, which is why I call them ascending bases. Each of the pullbacks usually occurs because the general market is declining at that time. Boeing formed a 13-week ascending base in the second quarter of 1954 and then doubled in price. Redmond Industries, a builder of mobile homes, had an 11-week ascending base in the first quarter of 1968 and proceeded to increase 500% in just 37 weeks. America Online created the same type of base in the first quarter of 1999 and resumed what turned out to be a 500% run-up from the breakout of a 14-week cup with handle in October 1998. So you see, history does repeat itself. The more historical patterns you know and come to recognize, the more money you should be able to make in future markets. See the chart examples in Chapter 1, and also Simmons Precision, Monogram Industries, Redmond Industries, America Online, and Titanium Metals. Wide and loose price structures are failure-prone. Wide and loose-looking charts usually fail, but can tighten up later. New England Nuclear and Houston Oil and Minerals are two cases of stocks that tightened up following wide, loose, and erratic price movements. I cite them because I missed both of them at the time. It's always wise to review big winners that you missed to find out why you didn't recognize them when they were exactly right and ready to soar. New England Nuclear formed a wide, loose, and faulty price pattern that looked like a double bottom from points A, B, C, D, and E. It declined about 40% from the beginning at point A to point D. That was excessive, and it took too much time, almost 6 months, to hit bottom. Note the additional clue provided by the declining trend of its relative strength line, RS, throughout the faulty pattern. Buying at point E was wrong. The handle was also too short and did not drift down to create a shakeout. It wedged up along its low points. New England Nuclear then formed a second base from points E to F to G. But if you tried to buy at point G, you were wrong again. It was premature because the price pattern was still wide and loose. The move from point E to point F was a prolonged decline, with relative strength deteriorating badly. The rise straight up from the bottom at point F to the bogus breakout point G was too fast and erratic, taking only 3 months. 3 months of improving relative strength versus the prior 17 months of decline weren't enough to turn the previous poor trend into a positive one. The stock then declined from point G to point H to form what appeared to be a handle area for the possible cup formation from points E to F to G. If you bought at point I on the breakout attempt, the stock failed again. Reason: the handle was too loose. It degenerated 20%. However, after failing that time, the stock at last tightened up its price structure from points I to J to K, and 15 weeks later, at point K, it broke out of a tight, sound base and nearly tripled in price afterwards. Note the stock's strong uptrend and materially improved relative strength line for 11 months from point K back to point F. So, there really is a right time and a wrong time to buy a stock, but understanding the difference requires some study. There's no such thing as being an overnight success in the stock market, and success has nothing to do with listening to tips from other people or being lucky. You have to study and prepare yourself so that you can become successful on your own with your investing. So make yourself more knowledgeable. It isn't easy at first, but it can be very rewarding. Anyone can learn to do it. You can do it. Believe in your ability to learn. Unlearn past assumptions that didn't work. Here are some faulty wide and loose patterns that faked people into buying during the prolonged bear market that began in March 2000. Veritas Software on October 20, 2000. Anaren Microwave on December 28, 2000. And Converse Technology on January 24, 2001. The aforementioned Houston Oil and Minerals is an even more dramatic example of the handle correction from point F to point G being a wide and loose pattern that later tightened up into a constructive price formation. See the accompanying chart. A to B to C was extremely wide, loose, and erratic. The percent decline was too great. B to C was straight up from the bottom without any pullback in price. Points C and D were false attempts to break out of a faulty price pattern, and so was point H, which tried to break out of a wide and loose cup with handle. Afterward, a tight 9-week base formed from points H to I to J. Note the extreme volume dry up along the December 1975 lows. An alert stockbroker in Hartford, Connecticut, called this structure to my attention. However, I'd been so conditioned by the 2 prior years of poor price patterns and less than desirable earnings that my mind was slow to change when the stock suddenly altered its behavior in only 9 weeks. I was probably also intimidated by the tremendous price increase that had occurred in Houston Oil in the earlier 1973 bull market. This proves that opinions and feelings are frequently wrong, but markets rarely are. It also points out a very important principle. It takes time for all of us to change opinions that we have built up over a substantial period. In this instance, even the current quarterly earnings turning up 357% after 3 down quarters didn't change my incorrect bearish view of the stock to a bullish one. The right buy point was in January 1976. In August 1994, PeopleSoft repeated the New England nuclear and Houston oil patterns. It failed in its breakout attempt from a wide, loose, wedging upward pattern in September 1993. It then failed a second time in its breakout attempt in March 1994, when its handle area formed in the lower half of its cup with handle pattern. Finally, when the chart pattern and the general market were right, PeopleSoft skyrocketed starting in August 1994. In the first week of January 1999, San Diego-based Qualcomm followed PeopleSoft's 3-phased precedent. In October 1997, Qualcomm charged into new high ground straight up from a loose, faulty base with too much of its base in its lower half. It then built a second faulty base, broke out of a handle in the lower part, and failed. The third base was the charm, a properly formed cup with handle that worked in the first week in January 1999. Qualcomm went straight through the roof from a split-adjusted $7.50 to $200 in only 1 year. Maybe you should spend more time studying historical precedents. What do you think? If you had invested $7,500 in Qualcomm, a year later it would have been worth $200,000. Detecting faulty price patterns and base structures. Unfortunately, no original or thorough research on price pattern analysis has been done in the last 78 years. In 1930, Richard Schabacker, a financial editor of Forbes, wrote a book, Stock Market Theory and Practice. In it, he discussed many patterns, including triangles, coils, and pennants. Our detailed model building and investigations of price structure over the years have shown these patterns to be unreliable and risky. They probably worked in the latter part of the Roaring '20s, when most stocks ran up in a wild, climactic frenzy. Something similar happened in 1999 and the first quarter of 2000, when many loose, faulty patterns at first seemed to work, but then failed. These periods were just like the Dutch tulip bulb craze of the 17th century, during which rampant speculation caused varieties of tulip bulbs to skyrocket to astronomical prices, and then crash. Our studies show that, with the exception of high, tight flags, which are extremely rare and hard to interpret, flat bases of 5 or 6 weeks, and the square box of 4 to 7 weeks, the most reliable base patterns must have a minimum of 7 to 8 weeks of price consolidation. Most coils, triangles, and pennants are simply weak foundations without sufficient time or price correction to become proper bases. 1, 2, and 3 week bases are risky. In almost all cases, they should be avoided. In 1948, John Magee and Robert D. Edwards wrote Technical Analysis of Stock Trends, a book that discusses many of the same faulty patterns presented in Schabacher's earlier work. In 1962, William Giler wrote an easy-to-read book, How Charts Can Help You in the Stock Market, that explains many of the correct principles behind technical analysis. However, it too seems to have continued the display and discussion of certain failure-prone patterns of the pre-depression era. Triple bottoms and head and shoulders bottoms are patterns that are widely mentioned in several books on technical analysis. We have found these to be weaker patterns as well. A head and shoulders bottom may succeed in a few instances, but it has no strong prior uptrend, which is essential for most powerful market leaders. When it comes to signifying a top in a stock, however, head and shoulders top patterns are among the most reliable. Be careful, if you have only a little knowledge of charts, you can misinterpret what is a correct head and shoulders top. Many pros don't interpret the pattern properly. The right second shoulder must be slightly below the left shoulder. See the chart for Alexander and Alexander. A triple bottom is a looser, weaker, and less attractive base pattern than a double bottom. The reason is that the stock corrects and falls back sharply to its absolute low 3 times rather than twice, as with a double bottom, or once, as in the strong cup with handle. As mentioned earlier, a cup with a wedging handle is also usually a faulty, failure-prone pattern, as you can see in the Global Crossing Limited. Chart example. A competent chart reader would have avoided or sold Global Crossing, which later went bankrupt. How to use relative price strength correctly. Many fundamental securities analysts think that technical analysis means buying those stocks with the strongest relative price strength. Others think that technical research refers only to the buying of high-momentum stocks. Both views are incorrect. It's not enough to just buy stocks that show the highest relative price strength on some list of best performers. You should buy stocks that are performing better than the general market, just as they are beginning to emerge from sound base building periods. The time to sell is when the stock has advanced rapidly, is extended materially from its base, and is showing extremely high relative price strength. To recognize the difference, you have to use daily or weekly charts. What is overhead supply? A critically important concept to learn in analyzing price movements is the principle of overhead supply. Overhead supply is when there are significant areas of price resistance in a stock as it moves up after experiencing a downtrend. These areas of resistance represent prior purchases of a stock and serve to limit and frustrate its upward movement because the investors who made these purchases are motivated to sell when the price returns to their entry point. See the chart for at home. For example, if a stock advances from $25 to $40, then declines back to $30, most of the people who bought it in the upper $30s and at $40 will have a loss in the stock unless they were quick to sell and cut their loss, which most people don't do. If the stock later climbs back to the high $30s or $40 area, the investors who had losses can now get out and break even. These are the holders who promised themselves, if I can just get out even, I will sell. Human nature doesn't change, so it's normal for a number of these people to sell when they see a chance to get their money back after having been down a large amount. Good chartists know how to recognize the price zones that represent heavy areas of overhead supply. They will never make the fatal mistake of buying a stock that has a large amount of recent overhead supply. This is a serious mistake that many analysts who are concerned solely with fundamentals sometimes make. A stock that's able to fight its way through its overhead supply, however, may be safer to buy, even though the price is a little higher. It has proved to have sufficient demand to absorb the supply and move past its level of resistance. Supply areas more than 2 years old create less resistance. Of course, a stock that has just broken out into new high ground for the first time has no overhead supply to contend with, which adds to its appeal. Excellent opportunities in unfamiliar, newer stocks. Alert investors should have a way of keeping track of all the new stock issues that have emerged over the last 10 years. This is important because some of these newer and younger companies will be among the most stunning performers of the next year or two. Most of these issues trade on the Nasdaq market. Some new issues move up a small amount and then retreat to new price lows during a bear market, making a poor initial impression. But when the next bull market begins, a few of these forgotten newcomers will sneak back up unnoticed, form base patterns, and suddenly take off and double or triple in price if they have earnings and sales that are good and improving. Most investors miss these outstanding price moves because they occur in new names that are largely unknown to most people. A charting service can help you spot these unfamiliar, newer companies, but make sure that your service follows a large number of stocks, not just 1 or 2,000. Successful, young growth stocks tend to enjoy their fastest earnings growth between their 5th and 10th years in business, so keep an eye on them during their early growth periods. To summarize, improve your stock selection and overall portfolio performance by learning to read and use charts. They provide a gold mine of information. It will take some time and study on your part to become good at this, but interpreting charts is easier than you think. A loud warning to the wise about bear markets. Let me offer one last bit of judicious guidance. If you are new to the stock market, or the historically tested and proven strategies outlined in this book, or more importantly, if you are reading this book for the first time near the beginning or middle of a bear market, do not expect the presumed buy patterns to work. Most of them will definitely be defective. You absolutely do not buy breakouts during a bear market. Most of them will fail. The price patterns will be too deep, wide, and loose in appearance compared to earlier patterns. They will be third and fourth stage bases, have wedging or loose, sloppy handles, have handles in the lower half of the base, or show narrow V formations moving straight up from the bottom of a base into new highs, without any handle forming. Some patterns may show laggard stocks with declining relative strength lines and price patterns with too much adverse volume activity or every week's price spread wide. It isn't that bases, breakouts, or the method isn't working anymore. It's that the timing and the stocks are simply all wrong. The price and volume patterns are phony, faulty, and unsound. The general market is turning negative. It is selling time. Be patient, keep studying, and be 100% prepared. Later, at the least expected time, when all the news is terrible, winter will ultimately pass and a great new bull market will suddenly spring to life. The practical techniques and proven disciplines discussed here should work for you for many, many future economic cycles. So get prepared and do your homework. Create your own buy and sell rules that you will constantly use. Chapter 3. C equals current big or accelerating quarterly earnings and sales per share. Dell Computer, Cisco Systems, America Online. Why, among the thousands of stocks that trade each day, did these three perform so well during the 1990s, posting gains of 1780%, 1467%, and 557%, respectively? Or for that matter, what about Google, which started trading at $85 a share in August 2004 and didn't stop climbing until it peaked at over $700 in 2007? Or Apple, which had emerged from a perfect cup with handle patterns 6 months earlier, at a split-adjusted $12 a share and reached $202 in 45 months. What key traits, among the hundreds that can move stocks up and down, did these companies all have in common? These are not idle questions. The answers unlock the secret to true success in the stock market. Our study of all the stock market superstars from the last century and a quarter found that they did indeed share common characteristics. None of these characteristics, however, stood out as boldly as the profits each big winner reported in the latest quarter or two, before its major price advance. For example, Dell's earnings per share surged 74% and 108% in the 2 quarters prior to its price increase from November 1996. Cisco posted earnings gains of 150% and 155% in the 2 quarters ending October 1990, prior to its giant run-up over the next 3 years. America Online's earnings were up 900% and 283% before its 6-month burst from October 1998. Google showed earnings gains of 112% and 123% in the 2 quarters before it made its spectacular debut as a public company. Apple's earnings were up 350% in the quarter before it took off, and its next quarter was up another 300%. But this isn't just a recent phenomenon. Explosive earnings have accompanied big stock moves throughout the stock market's great history in America. Studebaker's earnings were up 296% before it sped from $45 to $190 in 8 months in 1914. And Cuban American Sugar's earnings soared 1175% in 1916. The same year, its stock climbed from $35 to $230. In the summer of 1919, Stutz Motor Car was showing an earnings gain of 70% before the prestigious manufacturer of high-performance sports cars, you remember the Bearcat, don't you, raced from $75 to $385 in just 40 weeks. Earnings at U.S. cast iron pipe rose from $1.51 a share at the end of 1922 to $21.92 at the end of 1923, an increase of 1,352%. In late 1923, the stock traded at $30. By early 1925, it went for $250. And in March of 1926, DuPont de Nemours showed earnings up 259% before its stock took off from $41 that July and got to $230 before the 1929 break. In fact, if you look down a list of the market's biggest winners year in and year out, you'll instantly see the relationship between booming profits and booming stocks. And you'll see why our studies have concluded that the stocks you select should show a major percentage increase in current quarterly earnings per share, the most recently reported quarter, when compared to the prior year's same quarter. Seek stocks showing huge current earnings increases. In our models of the 600 best performing stocks from 1952 to 2001, 3 out of 4 showed earnings increases averaging more than 70% in the latest publicly reported quarter before they began their major advances. Those that did not show solid current quarterly earnings increases did so in the very next quarter, with an average earnings increase of 90%. Priceline.com was showing earnings up only 34% in the June quarter of 2006, when its stock began a move from $30 to $140. But its earnings accelerated, rising 53%, 107%, and 126% in the quarters that followed. From 1910 to 1950, most of the very best performers showed earnings gains ranging from 40% to 400% before their big price moves. So, if the best stocks had profit increases of this magnitude before they advanced rapidly in price, why should you settle for anything less? You may find that only 2% of all stocks listed on NASDAQ or the New York Stock Exchange will show earnings gains of this size. But remember, you're looking for stocks that are exceptional, not lackluster. Don't worry, they're out there. As with any search, however, there can be traps and pitfalls along the way, and you need to know how to avoid them. The earnings per share EPS number you want to focus on is calculated by dividing a company's total after tax profits by the number of common shares outstanding. This percentage change in EPS is the single most important element in stock selection today. The greater the percentage increase, the better. And yet, during the internet boom of the wild late 1990s, some people bought stocks based on nothing more than big stories of profits and riches to come, as most internet and .com companies had shown only deficits to date. Given that companies such as AOL and Yahoo were actually showing earnings, risking your hard-earned money in other, unproven stocks was simply not necessary. AOL and Yahoo were the real leaders at that time. When the inevitable market correction downturn hit, lower grade, more speculative companies with no earnings rapidly suffered the largest declines. You don't need that added risk. I am continually amazed at how some professional money managers, let alone individual investors, buy common stocks when the current reported quarter's earnings are flat, no change, or down. There is absolutely no good reason for a stock to go anywhere in a big, sustainable way if its current earnings are poor. Even profit gains of 5% to 10% are insufficient to fuel a major price movement in a stock. Besides, a company showing an increase of as little as 8% or 10% is more likely to suddenly report lower or slower earnings the next quarter. Unlike some institutional investors such as mutual funds, banks, and insurance companies, which have billions under management and which may be restricted by the size of their funds, individual investors have the luxury of investing in only the very best stocks in each bull cycle. While some companies with no earnings like Amazon.com and Priceline.com had big moves in their stocks in 1998-1999, most investors in that time period would have been better off buying stocks like America Online and Charles Schwab, both of which had strong earnings. Following the CanSlim strategy's emphasis on earnings ensures that an investor will always be led to the strongest stocks in any market cycle, regardless of any temporary, highly speculative bubbles or euphoria. Of course, you don't buy on earnings growth alone. Several other factors, which we'll cover in the chapters that follow, are almost as important. It's just that EPS is the most important. Watch out for misleading earnings reports. Have you ever read a corporation's quarterly earnings report that went like this? We had a terrible first 3 months. Prospects for our company are turning down because of inefficiencies at the home office. Our competition just came out with a better product, which will adversely affect our sales. Furthermore, we are losing our shirt on the new Midwestern operation, which was a real blunder on management's part. No way. Here's what you see instead. Great Shakes Corporation reports record sales of $7.2 million versus $6 million, plus 20% for the quarter ended March 31. If you're a Great Shakes stockholder, this sounds like wonderful news. You certainly aren't going to be disappointed. After all, you believe that this is a fine company. If you didn't, you wouldn't have invested in it in the first place, and the report confirms your thinking. But is this record-breaking sales announcement a good report? Let's suppose the company also had record earnings of $2.10 per share, up 5% from the $2.00 per share reported for the same quarter a year ago. Is it even better now? The question you have to ask is, why were sales up 20% but earnings ahead only 5%? What does this say about the company's profit margins? Most investors are impressed with what they read, and companies love to put their best foot forward in their press releases and TV appearances. However, even though this company's sales grew 20% to an all-time high, it didn't mean much for the company's profits. The key question for the winning investor must always be, how much are the current quarter's earnings per share up, in percentage terms, from the same quarter the year before? Let's say your company discloses that sales climbed 10% and net income advanced 12%. Sound good? Not necessarily. You shouldn't be concerned with the company's total net income. You don't own the whole organization, you own shares in it. Over the last 12 months, the company might have issued additional shares or diluted the common stock in other ways. So while net income may be up 12%, earnings per share, your main focus as an investor, may have edged up only 5% or 6%. You must be able to see through slanted presentations. Don't let the use of words like sales and net income divert your attention from the truly vital facts like current quarterly earnings. To further clarify this point, you should always compare a company's earnings per share to the same quarter a year earlier, not to the prior quarter, to avoid any distortion resulting from seasonality. In other words, you don't compare the December quarter's earnings per share to the prior September quarter's earnings per share. Rather, compare the December quarter to the December quarter of the previous year for a more accurate evaluation. Omit a company's one-time extraordinary gains. The winning investor should avoid the trap of being influenced by non-recurring profits. For example, If a computer maker reports earnings for the last quarter that include non-recurring profits from activities such as the sale of real estate, this portion of earnings should be subtracted from the report. Such earnings represent a one-time event, not the true, ongoing profitability of corporate operations. Ignore the earnings that result from such events. Is it possible that the earnings of New York Citigroup Bank may have been propped up at times during the 1990s by non-recurring sales of commercial real estate prior to the bank's later leveraged involvement in the subprime disaster? Set a minimum level for current earnings increases. Whether you're a new or an experienced investor, I would advise against buying any stock that doesn't show earnings per share up at least 18% or 20% in the most recent quarter versus the same quarter the year before. In our study of the greatest winning companies, we found that they all had this in common prior to their big price moves. Many successful investors use 25% or 30% as their minimum earnings parameter. To be even safer, insist that both of the last 2 quarters show significant earnings gains. During bull markets, major market uptrends, I prefer to concentrate on stocks that show powerful earnings gains of 40% to 500% or more. You have thousands of stocks to choose from. Why not buy the very best merchandise available? To further sharpen your stock selection process, look ahead to the next quarter or two and check the earnings that were reported for those same quarters the previous year. See if the company will be coming up against unusually large or small earnings achieved a year ago. When the unusual year earlier results are not caused by seasonal factors, this step may help you anticipate a strong or poor earnings report in the coming months. Also, be sure to check consensus earnings estimates, projections that combine the earnings estimates of a large group of analysts for the next several quarters, and for the next year or two, to make sure the company is projected to be on a positive track. Some earnings estimate services even show an estimated annual earnings growth rate for the next 5 years for many companies. Many individuals, and even some institutional investors buy stocks whose earnings were down in the most recently reported quarter because they like the company and think that its stock price is cheap. Usually they accept the story that earnings will rebound strongly in the near future. In some cases, this may be true, but in many cases it isn't. Again, the point is that you have the choice of investing in thousands of companies, many of which are actually showing strong operating results. You don't have to accept promises of earnings that may never occur. Requiring that current quarterly earnings be up a hefty amount is just another smart way for the intelligent investor to reduce the risk of mistakes in stock selection. But you must also understand that, in the late stage of a bull market, some or even many leaders that have had long runs may top out even though their earnings are up 100%. This usually fools investors and analysts alike. It pays to know your market history. Avoid big older companies with maintainer management. In fact, many older American corporations have mediocre management that continually produces second-rate earnings results. I call these people the entrenched maintainers, or caretaker management. You want to avoid these companies until someone has the courage to change the top executives. Not coincidentally, they are generally the companies that strain to pump up their current earnings a still dull 8% or 10%. True growth companies with outstanding new products or improved management do not have to inflate their current results. Look for accelerating quarterly earnings growth. Our analysis of the most successful stocks also showed that, in almost every case, earnings growth accelerated sometime in the 10 quarters before a towering price move began. In other words, it's not just increased earnings and the size of the increase that cause a big move. It's also that the increase represents an improvement from the company's prior rate of earnings growth. If a company's earnings have been up 15% a year and suddenly begins spurting 40% to 50% or more, what Wall Street usually calls earnings surprises, this usually creates the conditions for important stock price improvement. Other valuable ways to track a stock's earnings include determining how many times in recent months analysts have raised their estimates for the company plus the percentage by which several previous quarterly earnings reports have actually beaten the estimates. Look for sales growth as well as earnings growth. Strong and improving quarterly earnings should always be supported by sales growth of at least 25% for the latest quarter, or at least an acceleration in the rate of sales percentage improvement over the last 3 quarters. Certain newer issues, initial public offerings, may show sales growth, averaging 100% or more in each of the last 8, 10, or 12 quarters. Check all these stocks out. Take particular note if the growth of both sales and earnings has accelerated for the last 3 quarters. You don't want to get impatient and sell your stock if it shows this type of acceleration. Stick to your position. Some professional investors bought Waste Management at $50 in early 1998 because earnings had jumped 3 quarters in a row from 24% to 75% and 268%. But sales were up only 5%. Several months later, the stock collapsed to $15 a share. This demonstrates that companies can inflate earnings for a few quarters by reducing costs or spending less on advertising, research and development, and other constructive activities. To be sustainable, however, earnings growth must be supported by higher sales. Such was not the case with Waste Management. It also helps improve your batting average if the latest quarters after-tax profit margins for your stock selections are either at or near a new high and among the very best in the company's own industry. Yes, you have to do a little homework if you want to really improve your results. No pain, no gain. 2 quarters of major earnings deceleration can be trouble for your stock. Just as it's important to recognize when quarterly earnings growth is accelerating, it's also important to know when earnings begin to decelerate or slow down significantly. If a company that has been growing at a quarterly rate of 50% suddenly reports earnings gains of only 15%, that might spell trouble, and you may want to avoid that company. Even the best organizations can have a slow quarter every once in a while. So before turning negative on a company's earnings, I prefer to see 2 consecutive quarters of material slowdown. This usually means a decline of 2/3 or greater from the previous rate, a slowdown from 100% earnings growth to 30%, for example, or from 50% to 15%. Consult log-scale weekly graphs. Understanding the principle of earnings acceleration or deceleration is essential. Securities analysts who recommend stocks because of the absolute level of earnings expected for the following year could be looking at the wrong set of numbers. The fact that a stock earned $5 per share and expects to report $6 the next year, a favorable 20% increase, could be misleading unless you know the previous trend in the percentage rate of earnings change. What if earnings were previously up 60%? This partially explains why so few investors make significant money following the buy and sell recommendations of securities analysts. Logarithmic scale graphs are of great value in analyzing stocks because they clearly show the acceleration or deceleration in the percentage rate of quarterly earnings increases. 1 inch anywhere on the price or earnings scale represents the same percentage change. This is not true of arithmetically scaled charts. On an arithmetically scaled chart, a 100% price increase from $10 to $20 a share shows the same space change as a 50% increase from $20 to $30 a share. In contrast, a log scale graph would show the 100% increase as being twice as large as the 50% increase. As a do-it-yourself investor, you can take the latest quarterly earnings per share along with the prior 3 quarters EPS and plot them on a logarithmic scale graph to get a clear picture of earnings acceleration or deceleration. For the best companies, plotting the most recent 12-month earnings, each quarter should put the earnings per share point close to or already at new highs. Check other stocks in the group. For additional validation, check the earnings of other companies in your stocks industry group. If you can't find at least one other impressive stock displaying strong earnings in the group, chances are you may have selected the wrong investment. Where to find current quarterly earnings reports? Quarterly corporate earnings statements used to be published in the business sections of most local newspapers and financial publications every day. But many publications are downsizing their business sections these days, dropping data right and left. As a result, they no longer adequately cover the most important thing that investors need to know. This is not true of Investors Business Daily. IBD not only continues to provide detailed earnings coverage, but goes a step further and separates all new earnings reports into companies with up earnings and those reporting down results, so you can easily see who produced excellent gains and who didn't. Chart services such as Daily Graphs Registered and Daily Graphs Online also show earnings reported during the week, as well as the most recent earnings figures for every stock they chart. Once you locate the percentage change in earnings per share when compared to the same year-ago quarter, also compare the percentage change in EPS on a quarter-by-quarter basis. Looking at the March quarter, and then at the June, September, and December quarters will tell you if a company's earnings growth is accelerating or decelerating. You now have the first critical rule for improving your stock selection. Current quarterly earnings per share should be up a major percentage, 25% to 50% at a minimum, over the same quarter the previous year. The best companies might show earnings up 100% to 500% or more. A mediocre 10% or 12% isn't enough. When you're picking winning stocks, it's the bottom line that counts. Chapter 4, A, equals annual earnings increases. Look for big growth. Any company can report a good earnings quarter every once in a while. And as we've seen, strong current quarterly earnings are critical to picking most of the market's biggest winners. But they're not enough. To make sure the latest results aren't just a flash in the pan and the company you're looking at is of high quality, you must insist on more proof. The way to do that is by reviewing the company's annual earnings growth rate. Look for annual earnings per share that have increased in each of the last 3 years. You normally don't want the second year's earnings to be down, even if the results in the following year rebound to the highest level yet. It's the combination of strong earnings in the last several quarters, plus a record of solid growth in recent years that creates a superb stock, or at least one with a higher probability of success during an uptrending general market. Select stocks with 25% to 50% and higher annual earnings growth rates. The annual rate of earnings growth for the companies you pick should be 25%, 50%, or even 100% or more. Between 1980 and 2000, the median annual growth rate of all outstanding stocks in our study at their early emerging stage was 36%. 3 out of 4 big winners showed at least some positive annual growth over the 3 years, and in some cases the 5 years, preceding the stock's big run-ups. A typical earnings per share progression for the 5 years preceding the stock's move might be something like $0.70, $1.15, $1.85, $2.65, and $4.00. In a few cases, you might accept one down year in 5 as long as the following year's earnings move back to new high ground. It's possible a company could earn $4.00 a share one year, $5.00 the next, $6.00 the next, and then $3.00 a share. If the next annual earnings statement was, say, $4.00 per share versus the prior year's $3.00, this would not be a good report despite the 33% increase over the prior year. The only reason it might seem positive is that the previous year's earnings, $3.00 a share, were so depressed that any improvement would look good. The point is, profits are recovering slowly and are still well below the company's peak annual earnings of $6.00 a share. The consensus among analysts on what earnings will be for the next year should also be up. The more, the better. But remember, estimates are personal opinions, and opinions may be wrong, too high or too low. Actual reported earnings are facts. Look for a big return on equity. You should also be aware of 2 other measurements of profitability and growth: return on equity and cash flow per share. Return on equity, or ROE, is calculated by dividing net income by shareholders' equity. This shows how efficiently a company uses its money, thereby helping to separate well-managed firms from those that are poorly managed. Our studies show that nearly all the greatest growth stocks of the past 50 years had ROEs of at least 17%. The really superior growth situations will sport 25% to 50% ROEs. To determine cash flow, add back the amount of depreciation the company shows to reflect the amount of cash that is being generated internally. Some growth stocks can also show annual cash flow per share that is at least 20% greater than actual earnings per share. Check the stability of a company's 3-year earnings record. Through our research, we've determined another factor that has proved important in selecting growth stocks: the stability and consistency of annual earnings growth over the past 3 years. Our stability measurement, which is expressed on a scale of 1 to 99, is calculated differently from most statistics. The lower the figure, the more stable the past earnings record. The figures are calculated by plotting quarterly earnings for the past 3 or 5 years and fitting a trend line around the plotted points to determine the degree of deviation from the basic growth trend. Growth stocks with steady earnings tend to have a stability figure below 20 or 25. Companies with stability ratings over 30 are more cyclical and a little less dependable in terms of their growth. All other things being equal, you may want to look for stocks showing a greater degree of sustainability, consistency, and stability in past earnings growth. Some companies that are growing 25% per year could have a stability rating of 1, 2, or 3. When the quarterly earnings for several years are plotted on a log scale chart, the earnings line should be nearly straight, consistently moving up. In most cases, there will be some acceleration in the rate of increase in recent quarters. Earnings stability numbers are customarily shown right after a company's annual growth rate, but most analysts and investment services don't bother to make the calculation. We show them in many of our institutional products, as well as in daily graphs and daily graphs online, which are designed for individual investors. If you restrict your stock selections to ventures with proven growth records, you will avoid the hundreds of investments with erratic histories or cyclical recoveries in profits. A few such stocks could top out as they approach the peaks of their prior earnings cycle. What is a normal stock market cycle? History demonstrates most bull-up markets last 2 to 4 years and are followed by a recession or a bear-down market. Then another bull market starts. In the beginning phase of a new bull market, growth stocks are usually the first to lead and make new price highs. These are companies whose profits have grown quarter to quarter, but whose stocks have been held back by the poor general market conditions. The combination of a general market decline and a stock's continued profit growth will have compressed the price/earnings P/E ratio to a point where it is attractive to institutional investors, for whom P/Es are important. Cyclical stocks in basic industries such as steel, chemicals, paper, rubber, autos, and machinery usually lag in the new bull market's early phase. Young growth stocks will typically dominate for at least 2 bull market cycles. Then the emphasis may change to cyclicals, turnarounds, or other newly improved sectors for a short period. While 3 out of 4 big market winners in the past were growth stocks, 1 in 4 was a cyclical or turnaround situation. In 1982, Chrysler and Ford were 2 such spirited turnaround plays. Cyclical and turnaround opportunities led in the market waves of 1953-1955, 1963-1965, and 1974-1975. Cyclicals including paper, aluminum, autos, chemicals, and plastics returned to the fore in 1987, and home building stocks, which are also cyclical, have led in other periods. Examples of turnaround situations include IBM in 1994 and Apple in 2003. Yet even when cyclical stocks are in favor, some pretty dramatic young growth issues are also available. Cyclical stocks in the United States are often those in older, less efficient industries. Some of these companies weren't competitive until the demand for steel, copper, chemicals, and oil surged as a result of the rapid buildup of basic industries in China. That's why cyclicals were resurrected aggressively after the 2000 bear market ended in 2003. They are still cyclical stocks, however, and they may not represent America's true future. In addition, large, old-line companies in America frequently have the added disadvantage of size. They are simply too large to be able to innovate and continually renew themselves so that they can compete with nimble foreign rivals and with America's young new entrepreneurs. Rallies in cyclical stocks may tend to be more short-lived and prone to falter at the first hint of a recession or an earnings slowdown. Should you decide to buy a turnaround stock, Look for annual earnings growth of at least 5% to 10% and 2 straight quarters of sharp earnings recovery that lift results for the latest 12 months into or very near new high ground. Check the 12-month earnings line on a stock chart. The sharper the angle of the earnings upswing, the better. If the profit upswing is so dramatic that it reaches a new high, 1 quarter of earnings turnaround will sometimes suffice. Cleveland-Cliffs, a supplier of iron ore pellets to the steel industry, and now known as Cliffs Natural Resources, came from a deficit position to dramatically accelerate quarterly earnings in 2004 by 64% and then by 241%. With that impetus, the stock rapidly advanced 170% in the next 8 months. How to weed out the losers in a group. Insisting on 3 years of earnings growth will help you quickly weed out 80% of the stocks in any industry group. Growth rates for most stocks in most groups are lackluster or non-existent, unlike, for example, Xerox, which was growing at a 32% annual rate before its shares soared 700% from March 1963 to June 1966. Walmart stores, which consistently created an annual growth rate of 43%, before rocketing 11,200% from 1977 to 1990. Cisco Systems, whose earnings were exploding at a 257% rate in October 1990, and Microsoft, which was growing at a 99% clip in October 1986, before their enormous advances. Priceline.com, which from 2004 to 2006 more than doubled its earnings from 96 cents a share to $2.03, before it tripled in price in the next 5 quarters. Google, which had already expanded its earnings from 55 cents a share in 2002 to $2.51 a share in 2004, before its stock climbed from $200 to $700 by 2007. Keep in mind that an annual growth record doesn't necessarily make a company a solid growth stock. In fact, some so-called growth stocks report substantially slower growth than they did in earlier market periods. Many growth leaders in one cycle do not repeat in the next cycle. The stock of a company that has an outstanding 3-year growth record of 30%, but whose earnings growth has slowed to 10% or 15% in the last several quarters, acts like a fully mature growth stock. Older and larger organizations are usually characterized by slower growth, and many of them should be avoided. America is continually led and driven by new innovative entrepreneurial companies. They, and not our government, create our new industries. Insist on both annual and current quarterly earnings being excellent. A standout stock needs both a sound growth record in recent years and a strong current earnings record in the last several quarters. It's the powerful combination of these 2 critical factors, rather than one or the other, that creates a super stock, or at least one that has a higher chance for true success. The fastest way to find a company with strong and accelerating current earnings and solid 3-year growth is by checking the proprietary earnings per share EPS rating provided for every stock listed in Investors Business Daily's research stock tables. The EPS rating measures a company's 2 most recent quarters of earnings growth against the same quarters the year before, and examines its growth rate over the last 3 years. The results are then compared with those of all other publicly traded companies and rated on a scale from 1 to 99, with 99 being best. An EPS rating of 99 means a company has outperformed 99% of all other companies in terms of both annual and recent quarterly earnings performance. If the stock is newly issued and the company doesn't have a 3-year earnings record, look for big earnings increases and even bigger sales growth over the last 5 or 6 quarters. 1 or 2 quarters of profitability are often not enough and indicate a less proven stock that might fall apart somewhere down the line. Are price/earnings, P/E ratios really important? If you're like most investors, you've probably learned the most important thing you need to know about a stock is its P/E ratio. Well, prepare yourself for a bubble-bursting surprise. For years, analysts have used P/E ratios as their basic measurement tool in deciding whether a stock is undervalued, has a low P/E, and should be bought, or is overvalued, has a high P/E and should be sold. But our ongoing analysis of the most successful stocks from 1880 to the present shows that, contrary to most investors' beliefs, P/E ratios were not a relevant factor in price movement and have very little to do with whether a stock should be bought or sold. Much more crucial, we found, was the percentage increase in earnings per share. To say that a security is undervalued because it's selling at a low P/E or because it's in the low end of its historical P/E range can be nonsense. Primary consideration should be given to whether the rate of change in earnings is substantially increasing or decreasing. From 1953 through 1985, the average P/E ratio for the best performing stocks at their early emerging stage was 20. The average P/E of the Dow Jones Industrials over the same period was 15. As they advanced, the biggest winners expanded their P/Es by 125% to about 45. From 1990 to 1995, the real leaders began with an average P/E of 36 and expanded into the 80s, but these were just the averages. Beginning P/Es for most big winners ranged from 25 to 50, and the P/E expansions varied from 60 to 115. In the market euphoria of the late 1990s, these valuations increased to even greater levels. Value buyers missed almost all of these tremendous investments. Why you missed some fabulous stocks. These findings strongly suggest that if you weren't willing to buy growth stocks at 25 to 50 times earnings, or even much more, you automatically eliminated most of the best investments available. You missed Microsoft, Cisco Systems, Home Depot, America Online, and many, many others during their periods of greatest market performance. Our studies suggest P/E ratios are an end effect of accelerating earnings that, in turn, attract big institutional buyers, resulting in strong price performance. P/Es are not a cause of excellent performance. High P/Es, for example, were found to occur because of bull markets. Low P/Es, with the exception of those on cyclical stocks, generally occurred because of bear markets. In a roaring bull market, don't overlook a stock just because its P/E seems too high. It could be the next great winner. And never buy a stock just because the P/E ratio makes it look like a bargain. There are usually good reasons why the P/E is low, and there's no golden rule that prevents a stock that sells at 8 or 10 times earnings from going even lower and selling at 4 or 5 times earnings. Many years ago, when I first began to study the market, I bought Northrop at 4 times earnings and watched in disbelief as the stock declined to a P/E ratio of 2. How price/earnings ratios are misused. Many Wall Street analysts put a stock on their buy list because it's selling at the low end of its historical P/E range. They'll also recommend a stock when the price starts to drop, thereby lowering the P/E and making it seem like an even bigger bargain. In 1998, Gillette and Coca-Cola looked like great buys because they had sold off several points and their P/Es looked more attractive. In actuality, the earnings at both companies were showing a material deceleration that justified a lower valuation. A great deal of P/E analysis is based on personal opinions and theories that have been handed down through the years by analysts, academicians, and others, whose track records when it comes to making money in the market are both questionable and undocumented. In 2008, some Wall Street analysts recommended buying Bank of America all the way down. There are no safe, sure things in the market. That's why you need avoid or sell rules as well as buy rules. Reliance on P/E ratios often ignores more basic trends. The general market, for example, may have topped, in which case all stocks are headed lower. To say a company is undervalued, because at one time it was selling at 22 times earnings, and it can now be bought for 15, is ridiculous and somewhat naive. One way I do sometimes use P/E ratios is to estimate the potential price objective for a growth stock over the next 6 to 18 months based on its estimated future earnings. I may take the earnings estimate for the next 2 years and multiply it by the stock's P/E ratio at the initial chart base by point, then multiply the result by 100% or slightly more. This is the degree of P/E expansion possible on average if a growth stock has a major price move. This tells me what a growth stock could potentially sell for during bull market conditions. However, there are some bull markets and certain growth stocks that may have little or no P&E expansion. For example, if Charles Schwab's stock breaks out of its first base at $43.75 per share, as it did in late 1998, and its P&E ratio at the beginning buy point is 40, multiply 40 by 130% to see that the P&E ratio could possibly expand to 92 if the stock has a huge price move. Next, multiply the potential P&E ratio of 92 by the consensus earnings estimate 2 years out of $1.45 per share. This tells you what a possible price objective for your growth stock might be. The wrong way to analyze companies in an industry. Another faulty use of P&E ratios by amateurs and professionals alike is to evaluate the stocks in an industry and conclude the one selling at the cheapest P&E is always undervalued and therefore the most attractive purchase. The reality is, the lowest P&E usually belongs to the company with the most ghastly earnings record. The simple truth is that at any given time, stocks usually sell near their current value. The stock that sells at 20 times earnings is at that level for one set of reasons, and the stock that trades at 15 times earnings is at that level for another set of reasons. A stock selling at, say, 7 times earnings does so because its overall record is more deficient than that of a stock with a higher P&E ratio. Also, keep in mind that cyclical stocks normally have lower P&Es, and that even in good periods, they do not show the P&E expansion that occurs in growth stocks. You can't buy a Mercedes for the price of a Chevrolet, and you can't buy oceanfront property for the same price you'd pay for land a couple of miles inland. Everything sells for about what it's worth at the time based on the law of supply and demand. The increased value of great paintings was brought about almost single-handedly many years ago by a fine arts dealer named Joseph Duveen. He would travel to Europe and buy one-of-a-kind paintings by Rembrandt and others, paying more than the market price. He would then bring them back to the United States and sell them to Henry Ford and other industrialists of that era for substantially more than he had paid. In other words, Lord Duveen bought the one-of-a-kind masterpieces high and sold them much higher. The point is, anyone can buy a mediocre piece of art for a low price, but the very best costs more. The very best stocks, like the very best art, usually command a higher price. If a company's price and P&E ratio change in the near future, it's because conditions, events, psychology, and earnings have continued to improve or started to deteriorate. Eventually, a stock's P&E will reach a peak, but this normally occurs when the general market averages are topping out and starting a significant decline. It could also be a signal the company's rate of earnings growth is about to weaken. Its true high P&E stocks will be more volatile, particularly if they are in the high-tech area. The price of a high P&E stock can also temporarily get ahead of itself, but the same can be said for lower P&E stocks. Examples of high P&Es that were great bargains. In situations where small but captivating growth companies have revolutionary new products, what seems like a high P&E ratio can actually be low. For instance, Xerox, which introduced the first dry copier in 1959, sold for 100 times earnings in 1960, before it advanced 3,300% in price, from a split adjusted $5 to $170. Syntex, the first company to submit a patent for a birth control pill, sold for 45 times earnings in July 1963 before it advanced 400%. Genentech, a pioneer in the use of genetic information to develop new wonder drugs and the first biotech company to go public, was initially priced at 200 times earnings in November 1985. In 5 months, the new stock bolted 300%. America Online, whose software gave millions access to the revolutionary new world of the Internet, sold for over 100 times earnings in November 1994, before climbing 14,900% to its peak in December 1999. Google's P&E was in the 50s and 60s, from $115 a share in September 2004, until it hit $475 a share in early January 2006. The fact is, Investors with a bias against what they consider to be high P and E's will miss out on some of the greatest opportunities of this or any other time. During bull markets, in particular, such a bias could literally cost you a fortune. Don't sell high P and E stocks short. In June 1962, when the stock market was at rock bottom, a big Beverly Hills investor barged into the office of a broker friend of mine and shouted that, at 50 times earnings, Xerox was drastically overpriced. He proceeded to sell 2,000 shares short at $88, borrowing stock from his broker to sell in hopes the stock would decline and he could later buy it back cheaper, making money on the difference in price. Sure enough, the stock took off at once and ultimately reached a price of $1,300 before adjusting for splits with a P&E ratio that topped 80. So much for opinions about P&Es being too high. Investors' personal opinions are usually wrong. The market is almost always right. So stop fighting and arguing with the market. Concentrate on stocks with proven records of significant earnings growth in each of the last 3 years, plus strong recent quarterly improvements. Don't accept anything less. Chapter 5. N equals newer companies, new products, new management, new highs off properly formed bases. It takes something new to produce a startling advance in the price of a stock. It can be an important new product or service that sells rapidly and causes earnings to accelerate faster than previous rates of increase. Or it can be a change of management that brings new vigor, new ideas, or at least a new broom to sweep everything clean. New industry conditions, such as supply shortages, price increases, or the introduction of revolutionary technologies, can also have a positive effect on most stocks in an industry group. In our study of the greatest stock market winners, which now spans the period from 1880 through 2008, we discovered that more than 95% of successful stocks with stunning growth in American industry fell into at least one of these categories. In the late 1800s, there was the new railroad industry connecting every part of our country, electricity, the telephone, and George Eastman's camera. Edison created the phonograph, the motion picture camera, and the light bulb. Next came the auto, the airplane, and then the radio. The refrigerator replaced the icebox. Television, the computer, jet planes, the personal computer, fax machines, the internet, cell phones. America's relentless inventors and entrepreneurs never quit. They built and created America's amazing growth record with their new products and new companies. These, in turn, created millions and millions of new jobs and a higher standard of living for the vast majority of Americans. In spite of bumps in the road, most Americans are far better off than they or their parents were 30 or 50 years ago. New products that created super successes. The way a company can achieve enormous success, thereby enjoying large gains in its stock price, is by introducing dramatic new products into the marketplace. I'm not talking about a new formula for dish soap. I'm talking about products that revolutionize the way we live. Here are just a few of the thousands of entrepreneurial companies that drove America, and during their time in the sun, created millions of jobs and a higher standard of living in the United States than in other areas of the world. 1. Northern Pacific was chartered as the first transcontinental railroad. Around 1900, its stock rocketed more than 4,000% in just 197 weeks. 2. General Motors began as the Buick Motor Company. In 1913-1914, GM stock increased 1368%. 3. RCA by 1926 had captured the market for commercial radio. Then, from June 1927, when the stock traded at $50, it advanced on a per-split basis to $575 before the market collapsed in 1929. 4. After World War II, Rexall's new Tupperware division helped push the company's stock to $50 a share in 1958, from $16. 5. Thiokol came out with new rocket fuels for missiles in 1957-1959, propelling its shares from $48 to the equivalent of $355. 6. Syntex marketed the oral contraceptive pill in 1963. In 6 months, the stock soared from $100 to $550. 7. McDonald's, with low-priced fast food franchising, snowballed from 1967 to 1971 to create an 1,100% profit for stockholders. 8. Levitt's Furniture's stock soared 660% in 1970-1971 on the popularity of the company's giant warehouse discount furniture centers. 9. Houston Oil and Gas, with a major new oil field, ran up 968% in 61 weeks in 1972-1973 and picked up another 367% in 1976. 10. Computer Vision stock advanced 1235% in 1978-1980 with the introduction of its new CAD/CAM factory automation equipment. 11. Wang Labs Class B shares grew 1350% in 1978-1980 on the development of its new word processing office machines. 12. Price Company's stock shot up more than 15 times in 1982-1986 with the opening of a Southern California chain of innovative wholesale warehouse membership stores. 13. Amgen developed two successful new biotech drugs, Epigen and Neupogen, and the stock raced ahead from $60 in 1990 to the equivalent of $460 in early 1992. 14. Cisco Systems, yet another California company, created routers and networking equipment that enabled companies to link up geographically dispersed local area computer networks. The stock rose nearly 2,000% from November 1990 to March 1994. In 10 years, 1990 to 2000, it soared an unbelievable 75,000%. 15. International game technology surged 1,600% in 1991-1993 with new microprocessor-based gaming products. 16. Microsoft stock was carried up almost 1,800% from March 1993 to the end of 1999 as its innovative Windows software products dominated the personal computer market. 17. PeopleSoft, the #1 maker of personnel software, achieved a 20-fold increase in the 3.5 years starting in August 1994. 18. Dell Computer, the leader and innovator in build-to-order, direct PC sales, advanced 1780% from November 1996 to January 1999. 19. EMC, with superior computer memory devices, capitalized on the ever-increasing need for network storage and raced up 478% in the 15 months starting in January 1998. 20. AOL and Yahoo, the two top internet leaders providing consumers with the new portals, needed to access the wealth of services and information on the internet. Both produced 500% gains from the fall of 1998 to their peaks in 1999. 21. Oracle's database and e-business applications software drove its stock from $20 to $90 in only 29 weeks, starting in 1999. 22. Charles Schwab, the #1 online discount broker, racked up a 414% gain in just 6 months starting in late 1998, a period that saw a shift to online trading. 23. Hansen Naturals Monster Energy fruit drinks were a hit with the workout crowd, and its stock bolted 1219% in only 86 weeks beginning in late 2004. 24. Google gave the world instant information via the internet, and its stock advanced 536% from its initial offering in 2004. 25. Apple and the new iPod music player created a sensation that carried the company's stock up 1580% from a classic cup with handle base price pattern that was easy to spot on February 27, 2004, if you used charts. And if you missed that last golden opportunity, you had 4 more classic base pattern chances to buy Apple on August 27, 2004, July 15, 2005, September 1, 2006, and April 27, 2007 if you checked a chart book each week. In the years ahead, hundreds and thousands of new creative leaders just like these will continue to surface and be available for you to purchase. People from all over the world come to America to capitalize on its freedom and opportunity. That's one secret of our success that many countries do not have. So don't ever get discouraged and give up on the lifetime opportunity that the stock market will provide. If you study, save, prepare, and educate yourself, you too will be able to recognize many of the future big winners as they appear. You can do it if you have the necessary drive and determination. It doesn't make any difference who you are or where you came from or your current position in life. It's all up to you. Do you want to get ahead? The stock market's great paradox. There is another fascinating phenomenon we found in the early stage of all winning stocks. We call it the great paradox. Before I tell you what it is, I want you to look at the accompanying graphs of 3 typical stocks. Which one looks like the best buy to you, A, B, or C? Which would you avoid? We'll give you the answer at the end of this chapter. The staggering majority of individual investors, whether new or experienced, take delightful comfort in buying stocks that are down substantially from their peaks, thinking that they're getting a bargain. Among the hundreds of thousands of individual investors attending my investment lectures in the 1970s, 1980s, 1990s, and 2000s, many said that they do not buy stocks that are making new highs in price. This bias is not limited to individual investors, however. I have provided extensive historical precedent research for more than 600 major institutional investors, and I have found that a number of them are also bottom buyers. They, too, feel it's safer to buy stocks that look like bargains because they are either down a lot in price or actually selling near their lows. Our study of the greatest stock market winners proved that the old adage, buy low, sell high, was completely wrong. In fact, our study proved the exact opposite. The hard-to-believe great paradox in the stock market is what seems too high in price and risky to the majority usually goes higher eventually, and what seems low and cheap usually goes lower. Are you finding this high-altitude paradox a little difficult to act upon? Let me cite another study we conducted. In this one, we analyzed 2 groups of stocks, those that made new highs and those that made new lows over many bull market periods. The results were conclusive. Stocks on the new high list tended to go higher in price, while those on the new low list tended to go lower. Based on our research, a stock on Investors Business Daily's new price low list tends to be a pretty poor prospect and should be avoided. In fact, decisive investors should sell such stocks long before they ever get near the new low list. A stock making the new high list, especially one making the list for the first time while trading on big volume during a bull market, might be a prospect with big potential. How does a stock go from $50 to $100? If you can't bring yourself to buy a stock at a level it has never before achieved, ask yourself, what does a stock that has traded between $40 and $50 a share over many months and is now selling at $50 have to do to double in price? Doesn't it first have to go through $51, then $52, $53, $54, $55, and so on, all new price highs, before it can reach $100? As a smart investor, your job is to buy when a stock looks too high to the majority of conventional investors, and sell after it moves substantially higher and finally begins to look attractive to some of those same investors. If you had bought Cisco in November of 1990 at the highest price it had ever sold for, when it had just made a new high and looked scary, you would have enjoyed a nearly 75,000% increase from that point forward to its peak in the year 2000. The correct time to begin buying a stock. Just because a stock is making a new price high doesn't necessarily mean that this is the right time to buy. Using stock charts is an important piece of the stock selection process. A stock's historical price movement should be reviewed carefully, and you should look for stocks that are making new price highs as they break out of proper, correct bases. Refer back to Chapter 2 for more detail on reading charts and identifying chart patterns. The 100 great full-page examples in Chapter 1 should have given you a real head start. These correctly created breakouts are the points at which most really big price advances begin, and the possibility of a significant price move is the greatest. A sound consolidation, or base building, period could last from 7 or 8 weeks up to 15 months. As noted in Chapter 2, the perfect time to buy is during a bull market, just as a stock is starting to break out of its price base. See the America Online chart on page 178. If the stock is more than 5% or 10% above the exact buy point off the base, it should be avoided. Buying it at this level greatly increases the chance of getting shaken out in the next normal correction or sharp pullback in price. You can't just buy the best stocks any old time. There's a right time, and then there are all the other times. Answers to the market's great paradox. Now that you know the great paradox, would you still pick the same stock you did earlier in the chapter? The right one to buy was stock A Syntex Corp, which is shown on the next page. The arrow pointing to July 1963 weekly price movements indicates the buy point. This arrow coincides with the price and volume activity at the end of the stock chart, adjusted for a 3-for-1 split. Syntex enjoyed a major price advance from its July 1963 buy point. In contrast, stocks B Halliburton and C Comdata Network both declined, as you can see from the charts given on the next page. The arrows indicate where the corresponding charts shown earlier left off. Search for companies that have developed important new products or services, or that have benefited from new management or materially improved industry conditions. Then buy their stocks when they are emerging from sound, correctly analyzed price consolidation patterns and are close to or actually making new price highs on increased volume. Chapter 6, S equals supply and demand, big volume demand at key points. The price of almost everything in your daily life is determined by the law of supply and demand. What you pay for your lettuce, tomatoes, eggs, and beef depends on how much of each is available and how many people want these items. Even in former communist countries, where the difference between haves and have-nots was theoretically non-existent, supply and demand held sway. There, state-owned goods were always in short supply and were often available only to the privileged class or on the black market to those who could pay the exorbitant prices. This basic principle of supply and demand also applies to the stock market, where it is more important than the opinions of all the analysts on Wall Street, no matter what schools they attended, what degrees they earned, or how high their IQs. Big or small supply of stock. It's hard to budge the price of a stock that has 5 billion shares outstanding because the supply is so large. Producing a rousing rally in these shares would require a huge volume of buying, or demand. On the other hand, it takes only a reasonable amount of buying to push up the price of a stock with 50 million shares outstanding, a relatively smaller supply. So if you're choosing between two stocks to buy, one with 5 billion shares outstanding and the other with 50 million, the smaller one will usually be the better performer if other factors are equal. However, since smaller capitalization stocks are less liquid, they can come down as fast as they go up, sometimes even faster. In other words, with greater opportunity comes significant additional risk, but there are definite ways of minimizing your risk, which will be discussed in chapters 10 and 11. The total number of shares outstanding in a company's capital structure represents the potential amount of stock available. But market professionals also look at the floating supply, the number of shares that are available for possible purchase after subtracting stock that is closely held. Companies in which top management owns a large percentage of the stock, at least 1% to 3% in a large company, and more in small companies, generally are better prospects because the managers have a vested interest in the stock. There's another fundamental reason, besides supply and demand, why companies with a large number of shares outstanding frequently produce slower results. The companies themselves may be much older and growing at a slower rate. They are simply too big and sluggish. In the 1990s, however, bigger capitalization stocks outperformed small cap issues for several years. This was in part related to the size problem experienced by the mutual fund community. It suddenly found itself awash in new cash as more and more people bought funds. As a result, larger funds were forced to buy more bigger cap stocks. This need to put their new money to work made it appear that they favored bigger cap issues. But this was contrary to the normal supply/demand effect, which favors smaller cap stocks with fewer shares available to meet increases in institutional investor demand. Big cap stocks do have some advantages: greater liquidity, generally less downside volatility, better quality, and in some cases less risk. And the immense buying power that large funds have these days can make top-notch big stocks advance nearly as fast as shares of smaller companies. Pick entrepreneurial management rather than caretakers. Big companies may seem to have a great deal of power and influence, but size often begets a lack of imagination and productive efficiency. Large companies are often run by older and more conservative caretaker managements that are less willing to innovate, take risks, and move quickly and wisely to keep up with rapidly changing times. In most cases, top managers of large companies don't own a lot of their company's stock. This is a serious deficiency that should be corrected. To the savvy investor, it suggests that the company's management and employees don't have a personal interest in seeing the company succeed. In some cases, large companies also have multiple layers of management that separate senior executives from what's going on at the customer level. And for companies competing in a capitalist economy, the ultimate boss is the customer. Communication of information continues to change at an ever faster rate. A company that has a hot new product today will find its sales slipping within 2 or 3 years if it doesn't continue to bring relevant, superior new products to market. Most new products, services, and inventions come from young, hungry, and innovative small and medium-sized companies with entrepreneurial management. Not coincidentally, these smaller public and non-public companies grow faster and create somewhere between 80% and 90% of the new jobs in the United States. Many of them are in the service or technology and information industries. This is possibly where the great future growth of America lies. Microsoft, Cisco Systems, and Oracle are just a few examples of dynamic small-cap innovators of the 1980s and 1990s that continually grew and eventually became big-cap stocks. If a mammoth older company creates an important new product, it may not help the stock materially because the product will probably account for only a small percentage of the company's total sales and earnings. The product is simply a small drop in a bucket that's now just too big. Excessive stock splits may hurt. From time to time, companies make the mistake of splitting their stocks excessively. This is sometimes done on advice from Wall Street investment bankers. In my opinion, it's usually better for a company to split its shares 2 for 1 or 3 for 2 than to split them 3 for 1 or 5 for 1. When a stock splits 2 for 1, you get 2 shares for each share you previously held, but the new shares sell for half the price. Oversized splits create a substantially larger supply and may put a company in the more lethargic big cap status sooner. Incidentally, a stock will usually end up moving higher after its first split in a new bull market, but before it moves up, it will go through a correction for a period of weeks. It may be unwise for a company whose stock has gone up in price for a year or two to declare an extravagant split near the end of a bull market or in the early stage of a bear market. Yet this is exactly what many corporations do. Generally speaking, these companies feel that lowering the share price of their stock will attract more buyers. This may be the case with some smaller buyers, but it also may produce the opposite result: more sellers, especially if it's the second split within a year or two. Knowledgeable pros and a few shrewd individual traders will probably use the excitement generated by the oversized split as an opportunity to sell and take their profits. In addition, large holders who are thinking of selling might figure it will be easier to unload their 100,000 shares before a 3 for 1 split than to sell 300,000 shares afterward. And smart short sellers pick on stocks that are heavily owned by institutions and are starting to falter after huge price run-ups. A stock will often reach a price top around the second or third time it splits. Our study of the biggest winners found that only 18% of them had splits in the year preceding their great price advances. Qualcomm topped in December 1999, just after its 4 for 1 stock split. Look for companies buying their own stock in the open market. In most but not all cases, it's usually a good sign when a company, especially a small to medium-sized growth company that meets the CAN-SLIM criteria, buys its own stock in the open market consistently over a period of time. A 10% buyback would be considered big. This reduces the number of shares and usually implies that the company expects improved sales and earnings in the future. As a result of the buyback, the company's net income will be divided by a smaller number of shares, thereby increasing earnings per share. And as already noted, the percentage increase in earnings per share is one of the principal driving forces behind outstanding stocks. From the mid-1970s to the early 1980s, Tandy, Teledyne, and Metromedia successfully repurchased their own stock, and all three achieved higher EPS growth and spectacular stock gains. Charles Tandy once told me that when the market went into a correction and his stock was down, he would go to the bank and borrow money to buy back his stock, then repay the loans after the market recovered. Of course, this was also when his company was reporting steady growth in earnings. Tandy's split-adjusted stock increased from $2.75 to $60 in 1983. Metromedia's soared from $30 in 1971 to $560 in 1977. And Teledyne zoomed from $8 in 1971 to $190 in 1984. Teledyne used 8 separate buybacks to shrink its capitalization from 88 million shares to 15 million and increase its earnings from $0.61 a share to nearly $20. In 1989 and 1990, International Game Technology announced that it was buying back 20% of its stock. By September 1993, IGT had advanced more than 20 times. Another big winner, home builder NVR Inc., had large buybacks in 2001. All these were growth companies. I'm not sure that company buybacks when earnings are not growing are all that sound. A low corporate debt-to-equity ratio is generally better. After you've found a stock with a reasonable number of shares, check the percentage of the company's total capitalization represented by long-term debt or bonds. Usually, the lower the debt ratio, the safer and better the company. The earnings per share of companies with high debt-to-equity ratios could be clobbered in difficult periods when interest rates are high or during more severe recessions. These highly leveraged companies are generally of lower quality and carry substantially higher risk. The use of extreme leverage of up to 40-to-1 or 50-to-1 was common among banks, brokers, mortgage lenders, and quasi-government agencies like Fannie Mae and Freddie Mac starting in 1995 and continuing until 2007. These institutions were strongly encouraged by the federal government's actions to invest large amounts of money in subprime loans to lower-income buyers, which ultimately led to the financial and credit crisis in 2008. Rule 1 for all competent investors and homeowners is never ever borrow more than you can pay back. Excessive debt hurts all people, companies, and governments. A corporation that's been reducing its debt as a percentage of equity over the last 2 or 3 years is worth considering. If nothing else, interest costs will be sharply reduced, helping to generate higher earnings per share. Another thing to watch for is the presence of convertible bonds in the capital structure. Earnings could be diluted if and when the bonds are converted into shares of common stock. Evaluating supply and demand. The best way to measure a stock's supply and demand is by watching its daily trading volume. This is exceptionally important, and it's why investors' business daily stock tables show both a stock's volume of trading for the day and the percentage that volume is above or below the stock's average daily volume over the last 3 months. These measurements, plus a proprietary rating of the degree of recent accumulation or distribution in the stock, are invaluable pieces of information that are available in no other daily publication, including the Wall Street Journal. When a stock pulls back in price, you typically want to see volume dry up at some point, indicating that there is no further significant selling pressure. When the stock rallies in price, in most situations you want to see volume rise, which usually represents buying by institutions, not the public. When a stock breaks out of a price consolidation area, see Chapter 2 on chart reading and identifying the price patterns of winning stocks. Trading volume should be at least 40% or 50% above normal. In many cases, it will increase 100% or much more for the day, indicating solid buying of the stock and the possibility for further increases in price. Using daily and weekly charts helps you analyze and interpret a stock's price and volume action. Monthly charts are also of value. You should analyze a stock's base pattern week by week, beginning with the first week that the stock closes down in a newly formed base and continuing each week until you get to the current week, where you believe it may break out of the base. You want to judge how much price progress, up or down, the stock made during each week, and whether it was on increased or decreased volume from the prior week. You also want to note where the stock closed within the price spread of each week's high and low. You both do a week-by-week check and evaluate the pattern's overall shape to see if it is a sound pattern that's been under accumulation or if it has too many defects. Remember, stock of any size capitalization can be bought using the CanSlim system. But small-cap stocks will be substantially more volatile, both on the upside and on the downside. From time to time, the market will shift its emphasis from small to large caps and vice versa. Companies that are buying back their stock in the open market and that show considerable stock ownership by management are preferred. Chapter 7. L equals leader or laggard, which is your stock. People tend to buy stocks that make them feel either good or comfortable. But in a bull market populated by dynamic leaders that just keep surprising on the upside, these sentimental favorites often turn out to be the dullest laggards. Suppose you want to own a stock in the computer industry. If you buy the best performer in the group and your timing is right, you have a crack at real price appreciation. But if you buy a stock that hasn't moved much, or that has even fallen to a price that makes it seem like a bargain and therefore safer, chances are that you've picked a stock with little potential. There's a reason, after all, that it's at the bottom of the pile. Don't just dabble in stocks, buying what you like for whatever reason. Dig in, do some detective work, and find out what makes some stocks go up much more than others. You can do it if you work at it. Buy among the best 2 or 3 stocks in a group. The top 1, 2, or 3 stocks in a strong industry group can have unbelievable growth, while others in the pack may hardly stir. The great computer stocks in the bull market of 1979 and 1980, Wang Labs, Prime Computer, Datapoint, Rome, and Tandy, had 5, 6, and 7-fold advances before they topped and retreated. But the sentimental favorite, grand old IBM, just sat there, and Giants Burroughs, NCR, and Sperry Rand were just as lifeless. In the bull market of 1981-1983, however, IBM sprang to life and produced excellent results. In the retail sector, Home Depot advanced 10 times from 1988 to 1992, while the laggards in the home improvement niche, Waben and Hetchinger, dramatically underperformed. You should buy the really great companies, those that lead their industries and are number 1 in their particular fields. All of my best big winners, Syntex in 1963, Pick and Save from 1976 to 1983, Price Co. From 1982 to 1985, Franklin Resources from 1985 to 1986, Genentech from 1986 to 1987, Amgen from 1990 to 1991, America Online from 1998 to 1999, Charles Schwab from 1998 to 1999, Sun Microsystems from 1998 to 1999, Qualcomm in 1999, eBay from 2002 to 2004, Google from 2004 to 2007, and Apple from 2004 to 2007 were the number 1 companies in their industry space at the time I purchased them. By number 1, I don't mean the largest company or the one with the most recognized brand name. I mean the one with the best quarterly and annual earnings growth, the highest return on equity, the widest profit margins, the strongest sales growth, and the most dynamic stock price action. This type of company will also have a unique and superior product or service and be gaining market share from its older, less innovative competitors. Avoid sympathy stock moves. Our studies show that very little in the stock market is really new. History just keeps repeating itself. When I first bought stock in Syntex, the developer of the birth control pill, in July 1963 off a high, tight flag pattern, and it then rapidly shot up 400%, most people wouldn't touch it. The stock had just made a new price high at $100 on the American Stock Exchange, and its price plus its P/E ratio, 45, made it seem too high and scary. No brokerage firms had research reports on it then, and the only mutual fund that owned it, a value line fund, had sold it the prior quarter when it began moving up. Instead, several Wall Street investment firms later recommended GD Searle as a sympathy play. Searle had a product similar to Syntex's, and its stock looked much cheaper because it hadn't gone up as much, but its stock failed to produce the same results. Syntex was the leader, Searle the laggard. A sympathy play is a stock in the same industry group that is bought in the hope that the luster of the real leader will rub off on it, but the profits of such companies usually pale in comparison. The stocks will eventually try to move up in sympathy with the leader, but they never do as well. In 1970, Levitt's Furniture, the leader in the then new warehouse business, became an electrifying market winner. Wix Corp. copied Levitt's, and many people bought its shares because they were cheaper, but Wix never performed and ultimately got into financial trouble. Levitt's, meanwhile, appreciated 900% before it finally topped. As steel industry pioneer Andrew Carnegie said in his autobiography, "The first man gets the oyster, the second, the shell." Each new business cycle in America is driven by new innovators, inventors, and entrepreneurs. If our government really wants to create jobs and not welfare packages, the most powerful way would be to provide strong tax incentives for the first 2 or 3 years to people who want to start new, small entrepreneurial businesses. Our data show that in the last 25 years, small businesses in America were responsible for creating 80% to 90% of all new jobs. This is a significantly higher percentage than that shown in government data, where new jobs are not accounted for in a realistic, comprehensive manner. For example, the Small Business Administration defines a small business as one with fewer than 500 people. Yes, when Sam Walton started Walmart and Bill Gates started Microsoft, each company had maybe 30 or 40 people. A year later, they had maybe 75, the next year 120, then 200, then 320, then 501. From that point on, they were no longer considered to be small companies. But over the next 10 or 15 years, one of them created more than 1 million jobs and the other 500,000 jobs. Those jobs were all created by a dynamic entrepreneur who started a brand new company, and they should be recognized and counted as such. We have a huge database on all public companies. In the past 25 years, big business created no net new jobs. When a big business buys another company, thereby instantly padding its payrolls, it doesn't create new jobs. In fact, it usually consolidates and lays off people in duplicative positions. Many such companies also downsize over time. Our inefficient, bureaucratic government needs to start counting all jobs created by new or small businesses during their first 15 or 20 years in business. How to separate the leaders from the laggards, using relative price strength. If you own a portfolio of stocks, you must learn to sell the worst performers first and keep the best a little longer. In other words, always sell your mistakes while the loss is still small, and watch your better selections to see if they progress into your big winners. Human nature being what it is, most people do it backwards. They hold their losers and sell their winners, a formula that always leads to bigger losses. How do you tell which stock is better and which is worse? The fastest and easiest way is by checking its relative price strength, RS, rating in Investors Business Daily. The proprietary RS rating measures the price performance of a given stock against the rest of the market for the past 52 weeks. Every stock in the market is assigned a rating from 1 to 99, with 99 being best. An RS rating of 99 means that the stock has outperformed 99% of all other companies in terms of price performance. A RS of 50 means that half of all other stocks have done better and half have done worse. If your stock's RS rating is below 70, it is lagging the better performing stocks in the overall market. That doesn't mean that it can't go up in price. It just means that if by some chance it does go up, it'll probably go up less. From the early 1950s through 2008, the average RS rating of the best performing stocks before their major run-ups was 87. In other words, the best stocks were already doing better than nearly 9 out of 10 others when they were starting out on their most explosive advance yet. So the rule for those who are determined to be big winners in the stock market is, look for the genuine leaders and avoid laggards and sympathy plays. Don't buy stocks with relative strength ratings in the 40s, 50s, or 60s. The relative price strength rating is shown each day for all stocks listed in Investors Business Daily stock tables. You can't find this information in any other daily business or local newspaper. Updated RS ratings are also shown on the Daily Graphs online charting service. A stock's relative strength can also be plotted on a chart. If the RS line has been sinking for 7 months or more, or if the line has an abnormally sharp decline for 4 months or more, the stock's price behavior is highly questionable, and it should probably be sold. Pick 80s and 90s that are in sound and proper chart base patterns. If you want to upgrade your stock selection so that you're zeroing in on the leaders, restrict your purchases to companies showing RS ratings of 80 or higher. There's no point in buying a stock that's straggling behind. Yet that's exactly what many investors do, including some who work at America's largest investment firms. I don't like to buy stocks with relative price strength ratings less than 80. In fact, the really big moneymakers generally have RS ratings of 90 or higher just before they break out of their first or second base structure. The RS rating of a potential winning stock should be in the same league as a pitcher's fastball. The average big league fastball is clocked at 86 miles per hour, and the best pitchers throw heat in the 90s. When you buy a stock, make absolutely sure that it's coming out of a sound base or price consolidation area. Also make sure that you buy it at its exact buy or pivot point. As mentioned before, avoid buying stocks that are extended more than 5% or 10% above the precise initial buy point. This will keep you from chasing stocks that race up in price too rapidly and makes it less likely that you will be shaken out during sharp market sell-offs. The unwillingness of investors to set and follow minimum standards for stock selection reminds me of doctors years ago who were ignorant of the need to sterilize their instruments before each operation. They kept killing off patients until surgeons finally and begrudgingly accepted studies by researchers Louis Pasteur and Joseph Lister. Ignorance rarely pays off in any walk of life, and it's no different in the stock market. Finding new leaders during market corrections. Corrections, or price declines, in the general market can help you recognize new leaders, if you know what to look for. The more desirable growth stocks normally correct 1.5 to 2.5 times the general market averages. In other words, if the overall market comes down 10%, the better growth stocks will correct 15% to 25%. However, in a correction during a bull or upward trending market, the growth stocks that decline the least percentage-wise are usually your best selections. Those that drop the most are normally the weakest. Say the general market average suffers an intermediate-term correction of 10%, and 3 of your successful growth stocks come off 15%, 25%, and 35%. The 2 that are off only 15% or 25% are likely to be your best investments after they recover. A stock that slides 35% to 40% in a general market decline of 10% could be flashing a warning signal. In most cases, you should heed it. Once a general market decline is definitely over, the first stocks that bounce back to new price highs are almost always your authentic leaders. These chart breakouts continue week by week for about 13 weeks. The best ones usually come out in the first 3 or 4 weeks. This is the ideal period to buy stocks. You absolutely don't want to miss it. Be sure to read the chapter on general market direction carefully to learn how you determine it. Pros make many mistakes too. Many professional investment managers make the serious mistake of buying stocks that have just suffered unusually large price drops. Our studies indicate that this is a surefire way to get yourself in trouble. In June 1972, an otherwise capable institutional investor in Maryland bought Levitt's Furniture after its first abnormal price break, a 1-week drop from $60 to around $40. The stock rallied for a few weeks, then rolled over and broke to $18. In October 1978, several institutional investors bought Memorex, a leading supplier of computer peripheral equipment, when it had its first unusual price break and looked to be a real value. It later plunged. In September 1981, certain money managers in New York bought Dome Petroleum on a break from $16 to $12. To them, it seemed cheap, and a favorable story about the stock was going around Wall Street. Months later, Dome sold for $1. Institutional buyers snapped up Lucent Technologies, a Wall Street darling after it was spun off from AT&T in the mid-1990s, after it broke from $78 to $50. Later that year, it collapsed to $5. Also in 2000, many people bought Cisco systems when it dropped to 50 from its early year high of 82. The maker of computer networking equipment had been a huge winner in the 1990s when it soared 75,000%, so it looked cheap at $50. It went to $8 and never got back to $50. In 2008, 8 years after those buyers saw value at $50, Cisco was selling for only $17. To do well in the stock market, you've got to stop doing what got you into trouble in the past and create new and far better rules and methods to guide you in the future. Suppose Joe Investor missed buying Crocs, the footwear company, at a split-adjusted $15 as it came out of the perfect cup with handle pattern in September 2006. Suppose he also missed the next cup pattern in April 2007 at 28. Then the stock roars up to $75 by October, with earnings up 100% every quarter. A month later, however, the stock drops to 47, and Joe sees his chance to get into this big winner that he missed all the way up, and that's now at a cheaper price. But the stock just keeps falling, and by January 2009, it's trading at $1. Buying stocks on the way down is dangerous. You can get wiped out. So stop this risky bad habit. How about buying a blue chip, a top-flight bank that's a leader in its industry, Bank of America? In December 2006, it was $55 a share, but you could have gotten it cheaper a year later at $40. Another year later, however, it had plunged to $6. But you're still a long-term investor, getting your 4-cent dividend. This is why I say don't buy a supposed good stock on the way down, and why we recommend cutting all losses at 7% or 8%. Any stock can do anything. You must have rules to protect your hard-earned money. We all make mistakes. You must learn to correct yours without vacillating. None of the pros or individual investors who owned or bought Cisco, Crocs, or BOF, when they were falling, recognized the difference between normal price declines and highly abnormal big volume corrections that can signal potential disaster. But the real problem was they relied on stories they'd heard and a method of fundamental analysis that equates lower P/E ratios with value. They didn't heed the market action that could have told them what was really going on. Those who listen and learn the difference between normal and abnormal action are said to have a good feel for the market. Those who ignore what the market says usually pay a heavy price. Anyone who buys stocks on the way down in price because they look cheap will learn the hard way. This is how you can lose a lot of money. Look for abnormal strength on a weak market day. In the spring of 1967, I remember walking through a broker's office in New York on a day when the Dow Jones Industrial Average was down more than 12 points. That was a lot in those days, when the Dow was around 800 compared with 8,000 in 2008. When I looked up at the electronic ticker tape moving across the wall and showing prices, I saw that Control Data, a pioneer in supercomputers, was trading at $62, up 3.5 points on heavy volume. I bought the stock at once. I knew Control Data well, and this was highly abnormal strength in the face of a weak overall market. The stock later ran up to $150. In April 1981, just as the 1981 bear market was getting underway, MCI Communications, a telecommunications stock trading in the over-the-counter market, broke out of a price base at $15. It advanced to the equivalent of $90 in 21 months. This was another great example of highly abnormal strength during a weak market. L'Oréal, the tobacco company, did the same thing in the 1957 bear market. Software Toolworks soared in the down market of early 1990. Wireless telecom firm Qualcomm made big progress, even during the difficult mid-year market of 1999. And Taro Pharmaceutical late in 2000 bucked the bear market that had begun that spring. Also in 2000, home builder NVR took off at $50 and rode steadily lower interest rates up to $360 by March 2003. The new bull market in 2003 uncovered many leaders, including Apple, Google, Research in Motion, Potash, and several Chinese stocks. So don't forget, it seldom pays to invest in laggard stocks, even if they look tantalizingly cheap. Look for and confine your purchases to market leaders. Get out of your laggard losers if you're down 8% below the price you paid so that you won't risk getting badly hurt. Chapter 8. I equals institutional sponsorship. It takes big demand to push up prices, and by far the biggest source of demand for stocks is institutional investors, such as mutual funds, pension funds, hedge funds, insurance companies, large investment counselors, bank trust departments, and state, charitable, and educational institutions. These large investors account for the lion's share of each day's market activity. What is institutional sponsorship? Institutional sponsorship refers to the shares of any stock owned by such institutions. For measurement purposes, I have never considered brokerage research reports or analyst recommendations as institutional sponsorship, although a few may exert short-term influence on some securities for a few days. Investment advisory services and market newsletters also aren't considered to be institutional or professional sponsorship by this definition, because they lack the concentrated or sustained buying or selling power of institutional investors. A winning stock doesn't need a huge number of institutional owners, but it should have several at a minimum. 20 might be a reasonable minimum number in a few rare cases involving small or newer companies, although most stocks have many, many more. If a stock has no professional sponsorship, chances are that its performance will be more run-of-the-mill, as this means that at least some of the more than 10,000 institutional investors have looked at the stock and passed over it. Even if they're wrong, it still takes large buying volume to stimulate an important price increase. Look for both quality and increasing numbers of buyers. Diligent investors dig down yet another level. They want to know not only how many institutional sponsors a stock has, whether that number has steadily increased in recent quarters, and more importantly, whether the most recent quarter showed a materially larger increase in the number of owners. They also want to know who those sponsors are, as shown by services reporting this information. They look for stocks that are held by at least one or two of the more savvy portfolio managers who have the best performance records. This is referred to as analyzing the quality of sponsorship. In analyzing the recorded quality of a stock's institutional sponsorship, the latest 12 months plus the last 3 years of the investment performance of mutual fund sponsors are usually most relevant. A quick and easy way to get this information is by checking a mutual fund's 36-month performance rating in Investor's Business Daily. And a plus rating indicates that a fund is in the top 5% in terms of performance. Funds with ratings of B+ or higher are considered the better performers. Keep in mind that the rating of a good growth stock mutual fund may be a little lower during a bear market, when most growth stocks will definitely correct. Results may change significantly, however, if key portfolio managers leave one money management firm and go to another. The leaders in the ratings of top institutional mutual funds generally rotate and change slowly as the years go by. Several financial services publish fund holdings and the investment performance records of various institutions. For example, you can learn the top 25 holdings of each fund plus other data at Morningstar.com. In the past, mutual funds tended to be more aggressive in the market. More recently, new entrepreneurial-type investment counseling firms have cropped up to manage public and institutional money. Buy companies that show increasing sponsorship. As mentioned earlier, it's less crucial to know how many institutions own a stock than to know which of the limited number of better-performing institutions own a stock or have bought it recently. It's also key to know whether the total number of sponsors is increasing or decreasing. The main thing to look for is the recent quarterly trend. It's always best to buy stocks showing strong earnings and sales and an increasing number of institutional owners over several recent quarters. Note new stock positions bought in the last quarter. A significant new position taken by an institutional investor in the most recently reported period is generally more relevant than existing positions that have been held for some time. When a fund establishes a new position, chances are that it will continue to add to that position and be less likely to sell it in the near future. Reports on such activities are available about 6 weeks after the end of a fund's 3 or 6 month period. They are helpful to those who can identify the wiser picks and who understand correct timing and proper analysis of daily and weekly charts. Many investors feel that disclosures of a fund's new commitments are published too long after the fact to be of any real value. But these individual opinions typically aren't correct. Institutional trades also tend to show up on some ticker tapes as transactions of from 1,000 to 100,000 shares or more. Institutional buying and selling can account for up to 70% of the activity in the stocks of most leading companies. This is the sustained force behind most major price moves. About half of the institutional buying that shows up on the New York Stock Exchange ticker tape may be in humdrum stocks. Much of it may also be wrong. But out of the other half, you may have several truly phenomenal selections. Your task, then, is to separate intelligent, highly informed institutional buying from poor, faulty buying. This is hard at first, but it will get easier as you learn to apply and follow the proven rules, guidelines, and principles presented in this book. To get a better sense for what works in the market, it's important to study the investment strategies of a well-managed mutual fund. When reviewing the tables in Investor's Business Daily, look for growth funds with A or B+ ratings during bull markets, and then call to obtain a prospectus. From the prospectus, you'll learn the investment philosophy and techniques used by the individual funds as well as the type and caliber of stocks they've purchased. For example, Fidelity's Contra Fund, managed by Will Danoff, has been the best-performing large, multi-billion-dollar fund for a number of years. He scours the country and international equities to get in early on every new concept or story in a stock. Jim Stour's American Century Heritage and Gift Trust funds use computers to find aggressive stocks with accelerating percentage increases in recent sales and earnings. Ken Hebner's CGM Focus and CGM Mutual have both had superior results for many years. His Focus fund concentrates in only 20 stocks. This makes it more volatile, but Ken likes to make big sector bets that in most cases have worked very well for him. Jeff Vinnick was a top-flight manager at Fidelity who left and started what is regarded as one of the country's best-performing hedge funds. Janus 20, headquartered in Denver, runs a concentrated portfolio of fewer than 30 growth stocks. Some funds buy on new highs, others buy around lows and may sell on new highs. Is your stock over-owned by institutions? It's possible for a stock to have too much institutional sponsorship. Over-owned is a term we coined in 1969 to describe stocks in which institutional ownership has become excessive. The danger is that excessive sponsorship might translate into large potential selling if something goes wrong at the company, or if a bear market begins. Janus funds alone owned more than 250 million shares of Nokia and 100 million shares of America Online, which contributed to an adverse supply/demand imbalance in 2000 and 2001. WorldCom in 1999 and JDS Uniphase and Cisco Systems in 2000 and 2001 were other examples of over-owned stocks. Thus, the favorite 50 and other widely owned institutional stocks can be poor, risky prospects. By the time a company's strong performance is so obvious that almost all institutions own the stock, it's probably too late to climb aboard. The heart is already out of the watermelon. Look how many institutions thought Citigroup should be a core holding in the late 1990s and 2000s. At one point, during the 2008 bank subprime loan and credit crisis, the stock of this leading New York City bank got down to $3.00 and later $1.00. Only 2 years earlier, it was $57. This is why, since its first edition, How to Make Money in Stocks has always had 2 detailed chapters on the subject of when to sell your stock. Most investors have no rules or plan for when to sell. That is a serious mistake. The same goes for American International Group. In 2008, AIG had more than 3,600 institutional owners when it tanked to 50 cents from the over $100 it had sold for in 2000. The government-sponsored Fannie Mae collapsed to less than $1 during the same financial fiasco. America Online in the summer of 2001 and Cisco Systems in the summer of 2000 were also overowned by more than 1,000 institutions. This potential heavy supply can adversely affect a stock during bear market periods. Many funds will pile into certain leaders on the way up and pile out on the way down. An unassailable institutional growth stock tops. Some stocks may seem invincible, but the old saying is true: what goes up must eventually come down. No company is forever immune to management problems, economic slowdowns, and changes in market direction. Savvy investors know that in the stock market, there are few sacred cows, and there are certainly no guarantees. In June 1974, few people could believe it when William O'Neill plus Co. put Xerox on its institutional avoid, or sell list, at $115. Until then, Xerox had been one of the most amazingly successful and widely held institutional stocks, but our data indicated that it had topped and was headed down. It was also overowned. Institutional investors went on to make Xerox their most widely purchased stock for that year. But when the stock tumbled in price, it showed the true condition of the company at that time. That episode called attention to our institutional services firm and got us our first major insurance company account in New York City. The firm had been buying Xerox in the $80s on the way down until we persuaded it that it should be selling instead. We also received a lot of resistance in 1998 when we put Gillette, another sacred cow, on our avoid list near $60 before it tanked. Enron was removed from our new ideas list on November 29, 2000 at $72.91, and we stopped following it. 6 months later, it was $45, and 6 months after that it was below $5 and headed for bankruptcy. Here is a list of some of the technology stocks that were removed from our new stock market ideas. ENSMI Institutional Service Potential New Ideas List in 2000, when most analysts were incorrectly calling them buys. The lesson: don't be swayed by a stock's broad-based popularity or an analyst advising investors to buy stocks on the way down in price. Institutional sponsorship means market liquidity. Another benefit to you as an individual investor is that institutional sponsorship provides buying support when you want to sell your investment. If there's no sponsorship and you try to sell your stock in a poor market, you may have problems finding someone to buy it. Daily marketability is one of the big advantages of owning high-quality stocks in the United States. Real estate is far less liquid, and sales commissions and fees are much higher. Good institutional sponsorship provides continuous liquidity for you. In a poor real estate market, there is no guarantee that you can find a willing buyer when you want to sell. It could take you 6 months to a year, and you could sell for a much lower price than you expected. Stocks removed from ENSMI buys in 2000. In summary, buy only those stocks that have at least a few institutional sponsors with better than average recent performance records, and that have added institutional owners in recent quarters. If I find that a stock has a large number of sponsors, but that none of the sponsors is on my list of the 10 or so excellent performing funds, in the majority of cases, I will pass over the stock. Institutional sponsorship is one more important tool to use as you analyze a stock for purchase. Chapter 9, M equals market direction, how you can determine it. You can be right about every one of the factors in the last 6 chapters, but if you're wrong about the direction of the general market, and that direction is down, 3 out of 4 of your stocks will plummet along with the market averages, and you will certainly lose money big time, as many people did in 2000 and again in 2008. Therefore, in your analytical toolkit, you absolutely must have a proven, reliable method to accurately determine whether you're in a bull uptrending market or a bear downtrending market. Very few investors or stockbrokers have such an essential tool. Many investors depend on someone else to help them with their investments. Do these other advisors or helpers have a sound set of rules to determine when the general market is starting to get into trouble? That's not enough, however. If you're in a bull market, you need to know whether it's in the early stage or a later stage, and more importantly, you need to know what the market is doing right now. Is it weak and acting badly, or is it merely going through a normal intermediate decline, typically 8% to 12%? Is it doing just what it should be, considering the basic current conditions in the country, or is it acting abnormally strong or weak? To answer these and other vital questions, you'll want to learn to analyze the overall market correctly, and to do that, you must start at the most logical point. The market direction method that we discovered and developed many years ago is such a key element in successful investing that you'll want to reread this chapter several times until you understand and can apply it on a day-to-day basis for the rest of your investment life. If you learn to do this well, you should never in the future find your investment portfolio down 30% to 50% or more in a bad bear market. The best way for you to determine the direction of the market is to look carefully at, follow, interpret, and understand the daily charts of the 3 or 4 major general market averages and what their price and volume changes are doing on a day-to-day basis. This might sound intimidating at first, but with patience and practice, you'll soon be analyzing the market like a true pro. This is the most important lesson you can learn if you want to stop losing and start winning. Are you ready to get smarter? Are your future peace of mind and financial independence worth some extra effort and determination on your part? Don't ever let anyone tell you that you can't time the market. This is a giant myth passed on mainly by Wall Street, the media, and those who have never been able to do it, so they think it's impossible. We've heard from thousands of readers of this chapter and investors' business dailies, the big picture column, who have learned how to do it. They took the time to read the rules and do their homework so that they were prepared and knew exactly what facts to look for. As a result, they had the foresight and understanding to sell stocks and raise cash in March 2000, and from November 2007 to January 2008 and June 2008, protecting much of the gains they made during 1998 and 1999, and in the strong 5-year bull market in stocks that lasted from March 2003 to June 2008. The erroneous belief that you can't time the market, that it's simply impossible, that no one can do it, evolved more than 40 years ago after a few mutual fund managers tried it unsuccessfully. They had to both sell at exactly the right time and then get back into the market at exactly the right time. But because of their asset size problems, and because they had no system, it took a number of weeks for them to believe the turn and finally re-enter the market. They relied on their personal judgments and feelings to determine when the market finally hit bottom and turned up for real. At the bottom, the news is all negative, so these managers, being human, hesitated to act. Their funds therefore lost some relative performance during the fast turnarounds that frequently happen at market bottoms. For this reason, and despite the fact that twice in the 1950s, Jack Dreyfus successfully raised cash in his Dreyfus Fund at the start of a bear market, top management at most mutual funds imposed rigid rules on money managers that required them to remain fully invested 95% to 100% of assets. This possibly fits well with the sound concept that mutual funds are truly long-term investments. Also, because funds are typically widely diversified, owning 100 or more stocks spread among many industries, in time they will always recover when the market recovers. So owning them for 15 or 20 years has always been extremely rewarding in the past and should continue to be in the future. However, you, as an individual investor owning 5, 10, or 20 stocks, don't have a large size handicap. Some of your stocks can drop substantially and maybe never come back or take years to do so. Learning when it's wise to raise cash is very important for you, so study and learn how to successfully use this technique to your advantage. What is the general market? The general market is a term referring to the most commonly used market indexes. These broad indexes tell you the approximate strength or weakness in each day's overall trading activity and can be one of your earliest indications of emerging trends. They include the Standard & Poor's S&P 500. Consisting of 500 companies, this index is a broader, more modern representation of market action than the Dow. The Nasdaq Composite. This has been a somewhat more volatile and relevant index in recent years. The Nasdaq is home to many of the market's younger, more innovative and faster-growing companies that trade via the Nasdaq network of market makers. It's a little more weighted toward the technology sector. The Dow Jones Industrial Average (JIA). This index consists of 30 widely traded big-cap stocks. It used to focus primarily on large, cyclical, industrial issues, but it has broadened a little in recent years to include companies such as Coca-Cola and Home Depot. It's a simple, but rather out-of-date average to study because it's dominated by large, established, old line companies that grow more slowly than today's more entrepreneurial concerns. It can also be easily manipulated over short time periods because it's limited to only 30 stocks. The NYSE Composite. This is a market value weighted index of all stocks listed on the New York Stock Exchange. All these key indexes are shown in Investor's Business Daily in large, easy-to-analyze charts that also feature a moving average and an accumulation/distribution rating AX/DIS/RTG for each index. The accumulation/distribution rating tells you if the index has been getting buying support recently or is undergoing significant selling. I always try to check these indexes every day because a key change can occur over just a few weeks, and you don't want to be asleep at the switch and not see it. IBDS, the big picture column, also evaluates these indexes daily to materially help you in deciphering the market's current condition and direction. Why is skilled, careful market observation so important? A Harvard professor once asked his students to do a special report on fish. His scholars went to the library, read books about fish, and then wrote their expositions. But after turning in their papers, the students were shocked when the professor tore them up and threw them in the wastebasket. When they asked him what was wrong with the reports, the professor said, "If you want to learn anything about fish, sit in front of a fishbowl and look at fish." He made his students sit and watch fish for hours. Then they rewrote their assignment solely on their observations of the objects themselves. Being a student of the market is like being a student in this professor's class. If you want to learn about the market, you must observe and study the major indexes carefully. In doing so, you'll come to recognize when the daily market averages are changing at key turning points, such as major market tops and bottoms, and learn to capitalize on this with real knowledge and confidence. There's an important lesson here. To be highly accurate in any pursuit, you must observe and analyze the objects themselves carefully. If you want to know about tigers, you need to watch tigers, not the weather, not the vegetation, and not the other animals on the mountain. Years ago, when Lou Brock set his mind to breaking baseball's stolen base record, he had all the big league pitchers photographed with high-speed film from the seats behind first base. Then he studied the film to learn what part of each pitcher's body moved first when he threw to first base. The pitcher was the object that Brock was trying to beat, so it was the pitchers themselves that he studied in great detail. In the 2003 Super Bowl, the Tampa Bay Buccaneers were able to intercept 5 Oakland Raider passes by first studying and then concentrating on the eye movements and body language of Oakland's quarterback. They read where he was going to throw. Christopher Columbus didn't accept the conventional wisdom about the Earth being flat because he himself had observed ships at sea disappearing over the horizon in a way that told him otherwise. The government uses wiretaps, spy planes, unmanned drones, and satellite photos to observe and analyze objects that could threaten our security. That's how we discovered Soviet missiles in Cuba. It's the same with the stock market. To know which way it's going, you must observe and analyze the major general market indexes daily. Don't ever ask anyone, "What do you think the market's going to do?" Learn to accurately read what the market is actually doing each day as it is doing it. Recognizing when the market has hit a top or has bottomed out is frequently 50% of the whole complicated investment ballgame. It's also the key investing skill virtually all investors, whether amateur or professional, seem to lack. In fact, Wall Street analysts completely missed calling the market top in 2000, particularly the tops in every one of the high technology leaders. They didn't do much better in 2008. We conducted 4 surveys of IBD subscribers in 2008 and also received hundreds of letters from subscribers that led us to believe that 60% of IBD readers sold stock and raised cash in either December 2007 or June 2008 with the help of the big picture column, and by applying and acting on our rule about 5 or 6 distribution days over any 4 or 5 week period. They preserved their capital and avoided the brunt of the dramatic and costly market collapse in the fall of 2008 that resulted from excessive problems in the market for subprime mortgage real estate loans, which had been sponsored and strongly encouraged by the government. You may have seen some of our subscribers' comments in IBD at the top of a page space titled, "You Can Do It Too." You'll learn exactly how to apply IBD's general market distribution rules later in this chapter. The stages of a stock market cycle. The winning investor should understand how a normal business cycle unfolds and over what period of time. The investor should pay particular attention to recent cycles. There's no guarantee that just because cycles lasted 3 or 4 years in the past, they'll last that long in the future. Bull and bear markets don't end easily. It usually takes 2 or 3 tricky pullbacks up or down to fake out or shake out the few remaining speculators. After everyone who can be run in or run out has thrown in the towel, there isn't anyone left to take action in the same market direction. Then the market will finally turn and begin a whole new trend. Most of this is crowd psychology constantly at work. Bear markets usually end while business is still in a downtrend. The reason is that stocks are anticipating or discounting all economic, political, and worldwide events many months in advance. The stock market is a leading economic indicator, not a coincident or lagging indicator, in our government's series of key economic indicators. The market is exceptionally perceptive, taking all events and basic conditions into account. It will react to what is taking place and what it can mean for the nation. The market is not controlled by Wall Street. Its action is determined by millions of investors all across the country and thousands of large institutions, and is a consensus conclusion on whether it likes or doesn't like what it foresees, such as what our government is doing or about to do and what the consequences could be. Similarly, bull markets usually top out and turn down before a recession sets in. For this reason, looking at economic indicators is a poor way to determine when to buy or sell stocks and is not recommended. Yet, some investment firms do this very thing. The predictions of many economists also leave a lot to be desired. A few of our nation's presidents have had to learn this lesson the hard way. In early 1983, for example, just as the economy was in its first few months of recovery, the head of President Reagan's Council of Economic Advisors was concerned that the capital goods sector was not very strong. This was the first hint that this advisor might not be as sound as he should be. Had he understood historical trends, he would have seen that capital goods demand has never been strong in the early stage of a recovery. This was especially true in the first quarter of 1983, when U.S. plants were operating at a low percentage of capacity. You should check earlier cycles to learn the sequence of industry group moves at various stages of the market cycle. If you do, you'll see that railroad equipment, machinery, and other capital goods industries are late movers in a business or stock market cycle. This knowledge can help you get a fix on where you are now. When these groups start running up, you know you're near the end. In early 2000, computer companies supplying internet capital goods and infrastructure were the last stage movers, along with telecommunications equipment suppliers. Dedicated students of the market who want to learn more about cycles and the longer-term history of U.S. economic growth may want to write to Securities Research Company, 27 Wareham Street, 401, Boston, MA 02118, and purchase one of the company's long-term wall charts. Also, in 2008, Daily Graphs, Inc. created a 1900 to 2008 stock market wall chart that shows major market and economic events. Some charts of market averages also include major news events over the last 12 months. These can be very valuable, especially if you keep and review back copies. You then have a history of both the market averages and the events that have influenced their direction. It helps to know, for example, how the market has reacted to new faces in the White House, rumors of war, controls on wages and prices, changes in discount rates, or just loss of confidence and panics in general. The accompanying chart of the S&P 500 index shows several past cycles with the bear markets shaded. You should study the general market indexes each day. In bear markets, stocks usually open strong and close weak. In bull markets, they tend to open weak and close strong. The general market averages need to be checked every day, since reverses in trends can begin on any given few days. Relying on these primary indexes is a more direct, practical, and effective method for analyzing the market's behavior and determining its direction. Don't rely on other subsidiary indicators because they haven't been proven to be effective at timing. Listening to the many market newsletter writers, technical analysts, or strategists who pour over 30 to 50 different technical or economic indicators and then tell you what they think the market should be doing is generally a very costly waste of time. Investment newsletters can create doubt and confusion in an investor's mind. Interestingly enough, history shows that the market tends to go up just when the news is all bad, and these experts are most skeptical and uncertain. When the general market tops, you must sell to raise at least some cash, and to get off margin, the use of borrowed money to protect your account. As an individual investor, you can easily raise cash and get out in 1 or 2 days, and you can likewise re-enter later when the market is finally right. If you don't sell and raise cash when the general market tops, your diversified list of former market leaders can decline sharply. Several of them may never recover to their former levels. Your best bet is to learn to interpret daily price and volume charts of the key general market averages. If you do, you can't get too far off track, and you won't need much else. It doesn't pay to argue with the market. Experience teaches that second-guessing the market can be a very expensive mistake. The prolonged 2-year bear market of 1973-1974. The combination of the Watergate scandal and hearings and the 1974 oil embargo by OPEC made 1973-1974 the worst stock market catastrophe up to that time since the 1929-1933 depression. The Dow corrected 50%, but the average stock plummeted more than 70%. This was a big lesson for stockholders, and was almost as severe as the 90% correction the average stock showed from 1929 to 1933. However, in 1933, industrial production was only 56% of the 1929 level, and more than 13 million Americans were unemployed. The peak unemployment rate in the 1930s was 25%. It remained in double digits throughout the entire decade and was 20% in 1939. The markets were so demoralized in the prolonged 1973-1974 bear market that most members on the floor of the New York Stock Exchange were afraid the exchange might not survive as a viable institution. This is why it's absolutely critical that you study the market averages and learn how to protect yourself against catastrophic losses, for the sake of your health as well as your portfolio. You can learn to do this. Anyone can do it if they get serious and apply themselves. Is your money important to you? A 33% drop requires a 50% rise to break even. The importance of knowing the direction of the general market cannot be overemphasized. If you have a 33% loss in a portfolio of stocks, you need a 50% gain just to get to your break-even point. If, for example, you've allowed a $10,000 portfolio to drop to $66, a 33% decline. It has to rise $33 or 50% just to get you back where you started. In the 2007-2008 bear market, the S&P 500 fell more than 50%, meaning that a 100% rebound will be needed for the index to fully recover. And how easy is it for you to make 100%? Maybe it's time for you to learn what you're doing, adopt new rules and methods, and stop doing things that create 50% losses. You positively must always act to preserve as much as possible of the profit that you've built up during the bull market, rather than ride your investments back down through difficult bear market periods. To do this, you have to learn historically proven selling rules. See chapters 10 and 11 for more on selling rules. The myths about long-term investing and being fully invested. Many investors like to think of, or at least describe, themselves as long-term investors. Their strategy is to stay fully invested through thick and thin. Most institutions do the same thing, but such an inflexible approach can have tragic results, particularly for individual investors. Individuals and institutions alike may get away with standing pat through relatively mild, 25% or less bear markets, but many bear markets are not mild. Some, such as 1973-1974, 2000-2002, and 2007-2008 are downright devastating. The challenge always comes at the beginning, when you start to sense an impending bear market. In most cases, you cannot project how bad economic conditions might become or how long those bad conditions could linger. The war in Vietnam, inflation, and a tight money supply helped turn the 1969-1970 correction into a 2-year decline of 36.9%. Before that, bear markets averaged only 9 months and took the averages down 26%. Most stocks fall during a bear market, but not all of them recover. If you hold on during even a modest bear correction, you can get stuck with damaged merchandise that may never see its former highs. You definitely must learn to sell and raise at least some cash when the overall environment changes and your stocks are not working. Buy and hold, investors fell in love with Coca-Cola during the 1980s and 1990s. The soft drink giant chugged higher year after year, rising and falling with the market, but it stopped working in 1998, as did Gillette, another favorite of long-term holders. When the market slipped into its mild bear correction that summer, Coke followed along. 2 years later, after some of the market's most exciting gains in decades, Coke was still stuck in a downtrend. In some instances, stocks of this kind may come back. But this much is certain: Coke investors missed huge advances in 1998 and 1999 in names such as America Online and Qualcomm. The buy and hold strategy was also disastrous to anyone who held technology stocks from 2000 through 2002. Many high flyers lost 75% to 90% of their value, and some may never return to their prior highs. Take a look now at Time Warner, Corning, Yahoo, Intel, JDS Uniphase, and EMC, former market leaders in 1998-2000. Protecting yourself from market downturns. Napoleon once wrote that never hesitating in battle gave him an advantage over his opponents, and for many years he was undefeated. In the battlefield that is the stock market, there are the quick and there are the dead. After you see the first several definite indications of a market top, don't wait around. Sell quickly before real weakness develops. When market indexes peak and begin major downside reversals, you should act immediately by putting 25% or more of your portfolio in cash, selling your stocks at market prices. The use of limit orders, buying or selling at a specific price, rather than buying or selling at market prices using market orders, is not recommended. Focus on your ability to get into or out of a stock when you need to. Quibbling over an eighth or quarter point, or their decimal equivalents, could make you miss an opportunity to buy or sell a stock. Lightning fast action is even more critical if your stock account is on margin. If your portfolio is fully margined, with half of the money in your stocks borrowed from your broker, a 20% decline in the price of your stocks will cause you to lose 40% of your money. A 50% decline in your stocks could wipe you out. Never try to ride through a bear market on margin. In the final analysis, there are really only 2 things you can do when a new bear market begins: sell and retreat or go short. When you retreat, you should stay out until the bear market is over. This usually means 5 or 6 months or more. In the prolonged, problem-ridden 1969-1970 and 1973-1974 periods, however, it meant up to 2 years. The bear market that began in March 2000 during the last year of the Clinton administration lasted longer and was far more severe than normal. 9 out of 10 investors lost a lot of money, particularly in high-tech stocks. It was the end of a period of many excesses during the late 1990s, a decade when America got careless and let down its guard. It was the anything-goes period, with stocks running wild. Selling short can be profitable, but be forewarned, it's a very difficult and highly specialized skill that should be attempted only during bear markets. Few people make money at it. Short selling is discussed in more detail in Chapter 12, using stop-loss orders. If you use stop-loss orders, or mentally record a selling price and act upon it, a market that is starting to top out will mechanically force you, robot-like, out of many of your stocks. A stop-loss order instructs the specialist in the stock on the exchange floor that once the stock has dropped to your specified price, the order becomes a market order, and the stock will be sold out on the next transaction. It's usually better not to enter stop-loss orders. In doing so, You and other similarly minded investors are showing your hand to market makers, and at times they might drop the stock to shake out stop-loss orders. Instead, watch your stocks closely and know ahead of time the exact price at which you will immediately sell to cut a loss. However, some people travel a lot and aren't able to watch their stocks closely, and others have a hard time making sell decisions and getting out when they are losing. In such cases, stop-loss orders help compensate for distance and indecisiveness. If you use a stop-loss order, remember to cancel it if you change your mind and sell a stock before the order is executed. Otherwise, you could later accidentally sell a stock that you no longer own. Such errors can be costly. How you can learn to identify stock market tops. To detect a market top, keep a close eye on the daily S&P 500, NYSE Composite, Dow 30, and NASDAQ Composite as they work their way higher. On one of the days in the uptrend, volume for the market as a whole will increase from the day before, but the index itself will show stalling action, a significantly smaller price increase for the day compared with the prior day's price increase. I call this heavy volume without further price progress up. The average doesn't have to close down for the day, but in most instances it will, making the distribution, selling, as professional investors liquidate stock must easier to see. The spread from the average daily high to its daily low may, in some cases, be a little wider than on previous days. Normal liquidation near the market peak will usually occur on 3 to 5 specific days over a period of 4 or 5 weeks. In other words, the market comes under distribution while it's advancing. This is one reason so few people know how to recognize distribution. After 4 or 5 days of definite distribution over any span of 4 or 5 weeks, the general market will almost always turn down. 4 days of distribution, if correctly spotted over a 2 or 3 week period, are sometimes enough to turn a previously advancing market into a decline. Sometimes distribution can be spread over 6 weeks if the market attempts at some point to rally back to new highs. If you are asleep or unaware, and you miss the topping signals given off by the S&P 500, the NYSE Composite, the NASDAQ, or the Dow, which is easy to do since they sometimes occur on only a few days, you could be wrong about the market direction and therefore wrong on almost everything you do. One of the biggest problems is the time it takes to reverse investors' positive personal opinions and views. If you always sell and cut your losses 7% or 8% below your buy points, you may automatically be forced to sell at least 1 or 2 stocks as a correction in the general market starts to develop. This should get you into a questioning, defensive frame of mind sooner. Following this one simple but powerful rule of ours saved a lot of people big money in 2000 devastating decline in technology leaders, and in the 2008 subprime loan bear market. It takes only one of the indexes to give you a valid repeated signal of too much distribution. You don't normally need to see several of the major indexes showing 4 or 5 distribution days. Also, if one of the indexes is down for the day on volume larger than the prior day's volume, it should decline more than 0.2% for this to be counted as a distribution day. After the initial decline off the top, track each rally attempt on the way down. After the required number of days of increased volume distribution around the top and the first decline resulting from this, there will be either a poor rally in the market averages, followed by a rally failure, or a positive and powerful follow-through day up on price and volume. You should learn in detail exactly what signals to look for and remain unbiased about the market. Let the day-by-day averages tell you what the market has been doing and is doing. See how you can spot stock market bottoms later in this chapter for a further discussion of market rallies. 3 signs the first rally attempt may fail. After the market does top out, it typically will rally feebly and then fail. After the first day's rebound, for instance, the second day will open strongly but suddenly turn down near the end of the session. The abrupt failure of the market to follow through on its first recovery attempt should probably be met with further selling on your part. You'll know that the initial bounce back is feeble if 1. The index advances in price on the 3rd, 4th, or 5th rally day, but on volume that is lower than that of the day before. 2. The average makes little net upward price progress compared with its progress the day before. Or 3, the market average recovers less than half of the initial drop from its former absolute intraday high. When you see these weak rallies and failures, further selling is advisable. How can Slim and IBD Red flag the March 2000 Nasdaq top? In October 1999, the market took off on a furious advance. Fears of a Y2K meltdown on January 1, 2000 had faded. Companies were announcing strong profits for the third quarter just ended. Both leading tech stocks and speculative internet and biotechnology issues racked up huge gains in just 5 months. But cracks started to appear in early March 2000. On March 7, the Nasdaq closed lower on higher volume, the first time it had done so in more than 6 weeks. That's unusual action during a roaring bull market, but one day of distribution isn't significant on its own. Still, it was the first yellow flag and was worth watching carefully. 3 days later, the Nasdaq bolted up more than 85 points to a new high in the morning. But it reversed in the afternoon and finished the day up only 2 points on heavy volume that was 13% above average. This was the second warning sign. That churning action, a lot of trading but no real price progress, a clear sign of distribution, was all the more important because leading stocks started showing their own symptoms of hitting climax tops, action that will be discussed in Chapter 11. Just 2 days later, on March 14, the market closed down 4% on a large volume increase. This was the third major warning signal of distribution, and one where you should have been taking some selling action. The index managed to put together a suspect rally from March 16 to 24, then stalled again for a fourth distribution day. It soon ran out of steam and rolled over on heavier volume 2 days later for a fifth distribution day and a final, definite confirmation of the March 10 top. The market itself was telling you to sell, raise cash, and get out of your stocks. All you had to do was read it right and react, instead of listening to other people's opinions. Other people are too frequently wrong and are probably clueless about recognizing or understanding distribution days. During the next 2 weeks, the Nasdaq, along with the S&P 500, and the Dow suffered repeated bouts of distribution as the indexes sold off on heavier volume than on the prior day. Astute Slim investors who had read, studied, and prepared themselves by knowing exactly what to watch for had long since taken their profits. Study our chart examples of this and other market tops. History repeats itself when it comes to the stock market. You'll see this type of action again and again in the future. So get with it. How can Slim and IBD Red flag the 2007 top in the market? As mentioned earlier, several surveys showed that approximately 60% of IBD subscribers sold stock in 2008 before the rapid stock market break occurred. IBS, the big picture column, clearly pointed out in its special market pulse box when the market indexes had 5 distribution days and the outlook had switched to market in correction. And then the column suggested that it was time to raise cash. I'm sure most of those people had read and studied this chapter, including our description of how we retreated from the market in March 2000. They were finally able to use and apply IBS general market rules to preserve their gains and not have to undergo the severe declines that can occur when you have no protective rules or methods. And hopefully, those who didn't follow the rules will be able to better apply them in the future. Not too much happens by accident in the market. It requires effort on your part to learn what you need to know in order to spot every market top. Here's what Apple CEO Steve Jobs had to say about effort. The things I've done in my life have required a lot of years of work before they took off. Annotated market topping charts for the period from the 1976 top to the 2007 top are shown a few pages ahead. Historical tops for further study. Historically, intermediate-term distribution tops, those that are usually followed by 8% to 12% declines in the general market averages, occur as they did during the first week of August 1954. First, there was increased New York Stock Exchange volume without further upward price progress on the Dow Jones Industrials. That was followed the next day by heavy volume without further price progress up, and with a wide price spread from high to low on the Dow. Another such top occurred in the first week of July 1955. It was characterized by a price climax with a wide price spread from the day's low to its high, followed the next day by increased volume with the Dow closing down in price, and then, 3 days later, increased NYSE volume with the Dow again closing down. If you study the following daily market average graphs of several tops closely and understand how they came about, you'll come to recognize the same indications as you observe future market environments. Each numbered day on these charts is a distribution day. Follow the leaders for clues to a market top. The second most important indicator of a primary change in market direction, after the daily averages, is the way leading stocks act. After the market has advanced for a couple of years, you can be fairly sure that it's headed for trouble if most of the individual stock leaders start acting abnormally. One example of abnormal activity can be seen when leading stocks break out of third or fourth stage chart base formations on the way up. Most of these base structures will be faulty, with price fluctuations appearing much wider and looser. A faulty base, wide, loose, and erratic, can best be recognized and analyzed by studying charts of a stock's daily or weekly price and volume history. Another sign of abnormal activity is the climax top. Here, a leading stock will run up more rapidly for 2 or 3 weeks in a row after having advanced for many months. See Chapter 11 on selling. A few leaders will have their first abnormal price break off the top on heavy volume, but then be unable to rally more than a small amount from the lows of their correction. Still others will show a serious loss of upward momentum in their most recent quarterly earnings reports. Shifts in market direction can also be detected by reviewing the last 4 or 5 stock purchases in your own portfolio. If you haven't made a dime on any of them, you could be picking up signs of a new downtrend. Investors who use charts and understand market action know that very few leading stocks will be attractive around market tops. There simply aren't any stocks coming out of sound, properly formed chart bases. The best merchandise has been bought, played, and well picked over. Most bases will be wide and loose, a big sign of real danger that you must learn to understand and obey. All that's left to show strength at this stage are laggard stocks. The sight of sluggish or low-priced, lower-quality laggards strengthening is a signal to the wise market operator the up market may be near its end. Even turkeys can try to fly in a windstorm. During the early phase of a bear market, certain leading stocks will seem to be bucking the trend by holding up in price, creating the impression of strength, but what you're seeing is just a postponement of the inevitable. When they raid the house, they usually get everyone, and eventually all the leaders will succumb to the selling. This is exactly what happened in the 2000 bear market. Cisco and other high-tech leaders all eventually collapsed, in spite of the many analysts who incorrectly said that they should be bought. That's also what happened at the top of the Nasdaq in June and July of 2008. The steels, fertilizers, and oils that had led the 2003-2007 bull market all rolled over, and finally broke down after they appeared to be bucking the overall market top that actually began with at least 5 distribution days in October of 2007. U.S. steel tanked even though its next 2 quarterly earnings reports were up over 100%. Potash topped when its current quarter was up 181%, and its next quarter was up 220%. This fooled most analysts, who were focused on the big earnings that had been reported or were expected. They had not studied all past historical tops and didn't realize that many past leaders had topped when earnings were up 100%. Why did these stocks finally cave in? They were in a bear market that had begun 8 months earlier, in late 2007. Market tops, whether intermediate, usually 8% to 12% declines, or primary bull market peaks, sometimes occur 5, 6, or 7 months after the last major, by point in leading stocks and in the averages. Thus, top reversals are usually late signals, the last straw before a cave-in. In most cases, distribution or selling has been going on for days or even weeks in individual market leaders. Use of individual stock selling rules, which we'll discuss in chapters 10 and 11, should already have led you to sell 1 or 2 of your holdings on the way up, just before the market peak. Other bear market warnings. If the original market leaders begin to falter and lower priced, lower quality, more speculative stocks begin to move up, watch out. When the old dogs begin to bark, the market is on its last feeble leg. Laggards can't lead the market higher. Among the telltale signs are the poor quality stocks that start to dominate the most active list on market up days. This is simply a matter of weak leadership trying to command the market. If the best ones can't lead, the worst certainly aren't going to do so for very long. Many top reversals, when the market closes at the bottom of its trading range after making a new high that day, have occurred between the third and the ninth day of a rally after the averages moved into new high ground off small chart bases, meaning that the time span from the start to the end of the pattern was really too short. It's important to note that the conditions under which the tops occurred were all about the same. At other times, a topping market will recover for a couple of months and get back nearly to its old high or even above it before breaking down in earnest. This occurred in December 1976, January 1981, and January 1984. There's an important psychological reason for this. The majority of people in the market can't be exactly right at exactly the right time. In 1994, the Nasdaq didn't top until weeks after the Dow did. A similar thing happened in early 2000. The majority of people in the stock market, including both professional and individual investors, will be fooled first. It's all about human psychology and emotions. If you were smart enough to sell or sell short in January 1981, the powerful rebound in February and March probably forced you to cover your short sales at a loss or buy some stocks back during the strong rally. It was an example of how treacherous the market really can be at turning points. Don't jump back in too early. I didn't have much problem recognizing and acting upon the early signs of the many bear markets from 1962 through 2008, but a few times I made the mistake of buying back too early. When you make a mistake in the stock market, the only sound thing to do is to correct it. Don't fight it. Pride and ego never pay off, neither does vacillation when losses start to show up. The typical bear market, and some aren't typical, usually has 3 separate phases or legs of decline interrupted by a couple of rallies that last just long enough to convince investors to begin buying. In 1969 and 1974, a few of these phony, drawn-out rallies lasted up to 15 weeks. Most don't last that long. Many institutional investors love to bottom fish. They'll start buying stocks off a supposed bottom and help make the rally convincing enough to draw you in. You're better off staying on the sidelines in cash until a new bull market really starts. How you can spot stock market bottoms. Once you've recognized a bear market and have scaled back your stock holdings, the big question is how long you should remain on the sidelines. If you plunge back into the market too soon, the apparent rally may fade, and you'll lose money. But if you hesitate at the brink of the eventual roaring recovery, opportunities will pass you by. Again, the daily general market averages provide the best answer by far. Markets are always more reliable than most investors' emotions or personal opinions. At some point in every correction, whether that correction is mild or severe, the stock market will always attempt to rally. Don't jump back in right away. Wait for the market itself to confirm the new uptrend. A rally attempt begins when a major market average closes higher after a decline that happened either earlier in the day or during the previous session. For example, the Dow plummets 3% in the morning, but then recovers later in the day and closes higher. Or the Dow closes down 2% and then rebounds the next day. We typically call the session in which the Dow finally closes higher the first day of the attempted rally, although there have been some exceptions. For example, the first day of the early October market bottom in 1998 was actually down on heavy volume, but it closed in the upper half of that day's price range. Sit tight and be patient. The first few days of improvement can't tell you whether the rally will succeed. Starting on the 4th day of the attempted rally, look for one of the major averages to follow through with a booming gain on heavier volume than the day before. This tells you the rally is far more likely to be real. The most powerful follow-throughs usually occur on the 4th to 7th days of the rally. The 1998 bottom just mentioned followed through on the 5th day of the attempted rally. The market was up 2.1%. A follow-through day should give the feeling of an explosive rally that is strong, decisive, and conclusive, not begrudging and on the fence or barely up 1%. The market's volume for the day should in most cases be above its average daily volume, in addition to always being higher than the prior day's trading. Occasionally, but rarely, a follow-through occurs as early as the third day of the rally. In such a case, the first, second, and third days must all be very powerful, with a major average up 1% to 2% or more each session in heavy volume. I used to consider 1% to be the percentage increase for a valid follow-through day. However, in recent years, as institutional investors have learned of our system, we've moved the requirement up a significant amount for the Nasdaq and the Dow. By doing this, we are trying to minimize the possibility that professionals will manipulate a few of the 30 stocks in the Dow Jones average to create false or faulty follow-through days. There will be cases in which confirmed rallies fail. A few large institutional investors, armed with their immense buying power, can run up the averages on a particular day and create the impression of a follow-through. Unless the smart buyers are getting back on board, however, the rally will implode, sometimes crashing on heavy volume within the next several days. However, just because the market corrects the day after a follow-through doesn't mean the follow-through was false. When a bear market bottoms, it frequently pulls back and settles above or near the lows made during the previous few weeks. It is more constructive when these pullbacks, or tests, hold at least a little above the absolute intraday lows made recently in the market averages. A follow-through signal doesn't mean you should rush out and buy with abandon. It just gives you the go-ahead to begin buying high-quality stocks with strong sales and earnings as they break out of sound price bases, and it is a vital second confirmation the attempted rally is succeeding. Remember, no new bull market has ever started without a strong price and volume follow-through confirmation. It pays to wait and listen to the market. The following graphs are examples of several bottoms in the stock market between 1974 and 2003. The big money is made in the first 2 years. The really big money is usually made in the first 1 or 2 years of a normal new bull market cycle. It is at this point that you must always recognize and fully capitalize upon the golden opportunities presented. The rest of the up cycle usually consists of back and forth movement in the market averages, followed by a bear market. The year 1965 was one of the few exceptions, but that strong market in the third year of a new cycle was caused by the beginning of the Vietnam War. In the first or second year of a new bull market, there should be a few intermediate-term declines in the market averages. These usually last a couple of months, with the market indexes dropping by from 8% to an occasional 12% or 15%. After several sharp downward adjustments of this nature, and after at least 2 years of a bull market have passed, heavy volume without further upside progress in the daily market averages could indicate the early beginning of the next bear market. Since the market is governed by supply and demand, you can interpret a chart of the general market averages about the same way you read the chart of an individual stock. The Dow Jones Industrial Average and the S&P 500 are usually displayed in the better publications. Investors Business daily displays the Nasdaq Composite, the New York Stock Exchange Composite, and the S&P 500, with large-size daily price and volume charts stacked one on top of the other for ease of comparing the three. These charts should show the high, low, and close of the market averages day by day for at least 6 months, together with the daily NYSE and Nasdaq volume in millions of shares traded. Incidentally, when I began in the market about 50 years ago, an average day on the New York Stock Exchange was 3.5 million shares. Today, 1.5 billion shares are traded on average each day, an incredible 150-fold increase that clearly demonstrates beyond any question the amazing growth and success of our free enterprise, capitalist system. Its unparalleled freedom and opportunity have consistently attracted millions of ambitious people from all around the world who have materially increased our productivity and inventiveness. It has led to an unprecedented increase in our standard of living, so that the vast majority of Americans in all areas of our population are better off than they were before. There are always problems that need to be recognized and solved, but our system is the most successful in the world, and it offers remarkable opportunities to grow and advance to those who are willing to work, train, and educate themselves. The 100 charts in Chapter 1 are only a small sample of big past investment opportunities. Normal bear markets show 3 legs of price movement down, but there's no rule saying you can't have 4 or even 5 down legs. You have to evaluate overall conditions and events in the country objectively and let the market averages tell their own story. And you have to understand what that story is. Additional ways to identify key market turning points. Look for divergence of key averages. Several averages should be checked at market turning points to see if there are significant divergences, meaning that they are moving in different directions, one up and one down, or that one index is advancing or declining at a much greater rate than another. For example, if the Dow is up 100 and the S&P 500 is up only the equivalent of 20 on the Dow for the day, the S&P 500 being a broader index, it would indicate the rally is not as broad and strong as it appears. To compare the change in the S&P 500 to that in the Dow, divide the S&P 500 into the Dow average, and then multiply by the change in the S&P 500. For example, if the Dow closed at 9,000 and the S&P 500 finished at 900, the 9,000 Dow would be 10 times the S&P 500. Therefore, if the Dow, on a particular day, is up 100 points and the S&P 500 is up 5 points, you can multiply the 5 by 10 and find that the S&P 500 was up only the equivalent of 50 points on the Dow. The Dow's new high in January 1984 was accompanied by a divergence in the indexes. The broader-based, more significant S&P 500 did not hit a new high. This is the reason most professionals plot the key indexes together, to make it easier to spot non-confirmations at key turning points. Institutional investors periodically run up the 30-stock Dow while they liquidate the broader NASDAQ, or a list of technology stocks under cover of the Dow run-up. It's like a big poker game, with players hiding their hands, bluffing, and faking. Certain psychological market indicators might at times help. Now that trading in put and call options is the get-rich-quick scheme for many speculators, you can plot and analyze the ratio of calls to puts for another valuable insight into crowd temperament. Options traders buy calls, which are options to buy common stock, or puts, which are options to sell common stock. A call buyer hopes prices will rise. A buyer of put options wishes prices to fall. If the volume of call options in a given period of time is greater than the volume of put options, a logical assumption is that option speculators as a group are expecting higher prices and are bullish on the market. If the volume of put options is greater than that of calls, speculators hold a bearish attitude. When option players buy more puts than calls, the put-to-call ratio index rises a little above 1.0. Such a reading coincided with general market bottoms in 1990, 1996, 1998, and April and September 2001, but you can't always expect this to occur. The percentage of investment advisors who are bearish is an interesting measure of investor sentiment. When bear markets are near the bottom, the great majority of advisory letters will usually be bearish. Near market tops, most will be bullish. The majority is usually wrong when it's most important to be right. However, you cannot blindly assume that because 65% of investment advisors were bearish the last time the general market hit bottom, a major market decline will be over the next time the investment advisors index reaches the same point. The short interest ratio is the amount of short selling on the New York Stock Exchange, expressed as a percentage of total NYSE volume. This ratio can reflect the degree of bearishness shown by speculators in the market. Along bear market bottoms, you will usually see 2 or 3 major peaks showing sharply increased short selling. There's no rule governing how high the index should go, but studying past market bottoms can give you an idea of what the ratio looked like at key market junctures. An index that is sometimes used to measure the degree of speculative activity is the NASDAQ volume as a percentage of NYSE volume. This measure provided a helpful tip-off of impending trouble during the summer of 1983, when NASDAQ volume increased significantly relative to the big boards, NYSE. When a trend persists and accelerates, indicating wild, rampant speculation, you're close to a general market correction. The volume of Nasdaq trading has grown larger than that on the NYSE in recent years because so many new entrepreneurial companies are listed on the Nasdaq, so this index must be viewed differently now. Interpret the overrated advanced decline line. Some technical analysts religiously follow advanced decline, AD data. These technicians take the number of stocks advancing each day versus the number that are declining, and then plot that ratio on a graph. Advanced decline lines are far from precise because they frequently veer sharply lower long before a bull market finally tops. In other words, the market keeps advancing toward higher ground, but it is being led by fewer but better stocks. The advanced decline line is simply not as accurate as the key general market indexes because analyzing the market's direction is not a simple total numbers game. Not all stocks are created equal. It's better to know where the real leadership is and how it's acting than to know how many more mediocre stocks are advancing and declining. The NYSE AD line peaked in April 1998 and trended lower during the new bull market that broke out 6 months later in October. The AD line continued to fall from October 1999 to March 2000, missing one of the market's most powerful rallies in decades. An advanced decline line can sometimes be helpful when a clear-cut bear market attempts a short-term rally. If the AD line lags the market averages and can't rally, it's giving an internal indication that, despite the strength of the rally in the Dow or S&P, the broader market remains frail. In such instances, the rally usually fizzles. In other words, it takes more than just a few leaders to make a new bull market. At best, the advanced decline line is a secondary indicator of limited value. If you hear commentators or TV market strategists extolling its virtues bullishly or bearishly, they probably haven't done their homework. No secondary measurements can be as accurate as the major market indexes, so you don't want to get confused and overemphasize the vast array of other technical measures that most people use, usually with lackluster results. Watch Federal Reserve Board rate changes. Among fundamental general market indicators, changes in the Federal Reserve Board's discount rate, the interest rate the FRB charges member banks for loans, the Fed funds rate, the interest rate banks with fund reserves charge for loans to banks without fund reserves, and occasionally stock margin levels are valuable indicators to watch. As a rule, interest rates provide the best confirmation of basic economic conditions, and changes in the discount rate and the Fed funds rate are by far the most reliable. In the past, 3 successive significant hikes in Fed interest rates have generally marked the beginning of bear markets and impending recessions. Bear markets have usually, but not always, ended when the rate was finally lowered. On the downside, the discount rate increased to 6% in September 1987, just after Alan Greenspan became chairman, led to the severe market break that October. Money market indicators mirror general economic activity. At times, I have followed selected government and Federal Reserve Board measurements, including 10 indicators of the supply and demand for money and indicators of interest rate levels. History proves that the direction of the general market, and also that of several industry groups, is often affected by changes in interest rates because the level of interest rates is usually tied to tight or easy Fed monetary policy. For the investor, the simplest and most relevant monetary indicators to follow and understand are the changes in the discount rate and Fed funds rate. With the advent of program trading and various hedging devices, some funds now hedge portions of their portfolio in an attempt to provide some downside protection during risky markets. The degree to which these hedges are successful again depends greatly on skill and timing, but one possible effect for some managers may be to lessen the pressure to dump portfolio securities on the market. Most funds operate with a policy of being widely diversified and fully or nearly fully invested at all times. This is because most fund managers, given the great size of today's funds, billions of dollars, have difficulty getting out of the market and into cash at the right time, and most importantly, then getting back into the market fast enough to participate in the initial powerful rebound off the ultimate bottom. So they may try to shift their emphasis to big cap, semi-defensive groups. The Fed crushes the 1981 economy. The bear market and the costly, protracted recession that began in 1981, for example, came about solely because the Fed increased the discount rate in rapid succession on September 26, November 17, and December 5 of 1980. Its fourth increase on May 8, 1981, thrust the discount rate to an all-time high of 14%. That finished off the U.S. economy, our basic industries, and the stock market for the time being. Fed rate changes, however, should not be your primary market indicator because the stock market itself is always your best barometer. Our analysis of market cycles turned up three key market turns that the discount rate did not help predict. Independent Fed actions are typically very constructive, as the Fed tries to counteract overheated excesses or sharp contractions in our economy. However, its actions and results clearly demonstrate how much our overall federal government, not our stock markets reacting to all events, can and does at times significantly influence our economic future, for good or bad. In fact, the subprime real estate mortgage meltdown and the financial credit crisis that led to the highly unusual market collapse of 2008 can be easily traced to moves in 1995 by the then current administration to substantially beef up the Community Reinvestment Act, CRA, of 1977. These actions required banks to make more higher-risk loans in lower-income areas than they would otherwise have made. Failure to comply meant stiff penalties, lawsuits, and limits on getting approvals for mergers and branch expansion. Our government, in effect, encouraged and coerced major banks to lower their long-proven safe lending standards. Most of the more than $1 trillion of new subprime CRA loans had adjustable rates. Many such loans eventually came to require no documentation of the borrower's income, and in some cases little or no down payment. In addition, for the first time, new regulatory rules not only allowed but encouraged lenders to bundle the new, riskier subprime loans with prime loans, and sell these assumed government-sponsored loan packages to other institutions and countries that thought they were buying safe AAA bonds. The first of these bundled loans hit the investment market in 1997. That action allowed loan originators and big banks to make profits faster and eliminate future risk and responsibility for many of those lower-quality loans. It let the banks turn around and make even more CRA-type loans, then sell them off in packages again, with little future risk or responsibility. In time, the unintended result was a gigantic government-sponsored pyramiding mechanism, with Fannie Mae and Freddie Mac providing the implied government backing by buying vast quantities of the more risky subprimes. This led to their facing bankruptcy and needing enormous government bailouts. Freddie and Fannie's management had also received huge bonuses and were donors to certain members of Congress, who repeatedly defended the highly leveraged, extremely risky lending against any sound reforms. Bottom line, this was a big government program that was started with absolutely good, worthy social intentions, but with little insight and absolutely zero foresight that over time resulted in severe damage and enormous unintended consequences that affected almost everything and everyone, including, sadly, the very lower-income people that this rather inept government operation was supposed to be helping. It put our whole financial system in jeopardy. Big Wall Street firms got involved after the rescinding of the Glass-Steagall Act in 1998, and both political parties, Congress, and the public all played key parts in creating the great financial fiasco. The 1962 stock market break. Another notable stock market break occurred in 1962. In the spring, nothing was wrong with the economy, but the market got skittish after the government announced an investigation of the stock market and then got on the steel companies for raising prices. IBM dropped 50%. That fall, after the Cuban Missile Showdown with the Russians, a new bull market sprang to life. All of this happened with no change in the discount rate. There have also been situations in which the discount rate was lowered 6 months after the market bottom was reached. In such cases, you would be late getting into the game if you waited for the discount rate to drop. In a few instances, after Fed rate cuts occurred, the markets continued lower or whipsawed for several months. This also occurred dramatically in 2000 and 2001. The hourly market index and volume changes. At key turning points, an active market operator can watch the market indexes and volume changes hour by hour and compare them to volume in the same hour of the day before. A good time to watch hourly volume figures is during the first attempted rally following the initial decline off the market peak. You should be able to see if volume is dull or dries up on the rally. You can also see if the rally starts to fade late in the day, with volume picking up as it does, a sign that the rally is weak and will probably fail. Hourly volume data also come in handy when the market averages reach an important prior low point and start breaking that support area. A support area is a previous price level below which investors hope that an index will not fall. What you want to know is whether selling picks up dramatically or by just a small amount as the market collapses into new low ground. If selling picks up dramatically, it represents significant downward pressure on the market. After the market has undercut previous lows for a few days, but on only slightly higher volume, look for either a volume dry-up day or 1 or 2 days of increased volume without the general market index going lower. If you see this, you may be in a shakeout area when the market pressures many traders to sell, often at a loss, ready for an upturn after scaring out weak holders. Overbought and oversold, two risky words. The short-term overbought/oversold indicator has an avid following among some individual technicians and investors. It's a 10-day moving average of advances and declines in the market. But be careful. At the start of a new bull market, the overbought/oversold index can become substantially overbought. This should not be taken as a sign to sell stocks. A big problem with indexes that move counter to the trend is that you always have the question of how bad things can get before everything finally turns. Many amateurs follow and believe in overbought/oversold indicators. Something similar can happen in the early stage or first leg of a major bear market, when the index can become unusually oversold. This is really telling you that a bear market may be imminent. The market was oversold all the way down during the brutal market implosion of 2000. I once hired a well-respected professional who relied on such technical indicators. During the 1969 market break, at the very point when everything told me the market was getting into serious trouble, and I was aggressively trying to get several portfolio managers to liquidate stocks and raise large amounts of cash, he was telling them that it was too late to sell because his overbought/oversold indicator said that the market was already very oversold. You guessed it, the market then split wide open. Needless to say, I rarely pay attention to overbought/oversold indicators. What you learn from years of experience is usually more important than the opinions and theories of experts using their many different favorite indicators. Other general market indicators. Upside/downside volume is a short-term index that relates trading volume in stocks that close up in price for the day to trading volume in stocks that close down. This index, plotted as a 10-week moving average, may show divergence at some intermediate turning points in the market. For example, after a 10% to 12% dip, the general market averages may continue to penetrate into new low ground for a week or two. Yet the upside/downside volume may suddenly shift and show steadily increasing upside volume, with downside volume easing. This switch usually signals an intermediate-term upturn in the market. But you'll pick up the same signals if you watch the changes in the daily Dow, Nasdaq, or S&P 500, and the market volume. Some services measure the percentage of new money flowing into corporate pension funds that is invested in common stocks and the percentage that is invested in cash equivalents or bonds. This opens another window into institutional investor psychology. However, majority, or crowd, thinking is seldom right, even when it's done by professionals. Every year or two, Wall Street seems to be of one mind, with everyone following each other like a herd of cattle. Either they all pile in or they all pile out. An index of defensive stocks, more stable and supposedly safer issues, such as utilities, tobaccos, foods, and soaps, may often show strength after a couple of years of bull market conditions. This may indicate the smart money is slipping into defensive positions and that a weaker general market lies ahead. But this doesn't always work. None of these secondary market indicators is anywhere near as reliable as the key general market indexes. Another indicator that is helpful at times in evaluating the stage of a market cycle is the percentage of stocks in defensive or laggard categories that are making new price highs. In pre-1983 cycles, some technicians rationalized their lack of concern with market weakness by citing the number of stocks that were still making new highs. But analysis of new high lists shows that a large percentage of preferred or defensive stocks signals bear market conditions. Superficial knowledge can hurt you in the stock market. To summarize this complex but vitally important chapter, learn to interpret the daily price and volume changes of the general market indexes and the action of individual market leaders. Once you know how to do this correctly, you can stop listening to all the costly, uninformed, personal market opinions of amateurs and professionals alike. As you can see, the key to staying on top of the stock market is not predicting or knowing what the market is going to do. It's knowing and understanding what the market has actually done in the past several weeks and what it is currently doing now. We don't want to give personal opinions or predictions. We carefully observe market supply and demand as it changes day by day. One of the great values of this system, of interpreting the price and volume changes in the market averages, is not just the ability to better recognize market top and bottom areas, but also the ability to track each rally attempt when the market is on its way down. In most instances, waiting for powerful follow-through days keeps you from being drawn prematurely into rally attempts that ultimately end in failure. In other words, you have rules that will continue to keep you from getting sucked into phony rallies. This is how we were able to stay out of the market and in money market funds for most of 2000 through 2002, preserve the majority of the gains we had made in 1998 and 1999, and help those who read and followed our many basic rules. There is a fortune for you in this paragraph. Part I review, how to remember and use what you've read so far. It isn't enough just to read. You need to remember and apply all of what you've read. The CanSlim system will help you remember what you've read so far. Each letter in the CanSlim system stands for one of the 7 basic fundamentals of selecting outstanding stocks. Most successful stocks have these 7 common characteristics at emerging growth stages, so they are worth committing to memory. Repeat this formula until you can recall and use it easily. C equals current quarterly earnings per share. Quarterly earnings per share must be up at least 18% or 20%, but preferably up 40% to 100% or 200% or more. The higher, the better. They should also be accelerating at some point in recent quarters. Quarterly sales should also be accelerating or up 25%. A equals annual earnings increases. There must be significant 25% or more growth in each of the last 3 years, and a return on equity of 17% or more, with 25% to 50% preferred. If return on equity is too low, pre-tax profit margin must be strong. N equals new products, new management, new highs. Look for new products or services, new management, or significant new changes in industry conditions. And most important, buy stocks as they emerge from sound, properly formed chart bases and begin to make new highs in price. S equals supply and demand. Shares outstanding plus big volume demand. Any size capitalization is acceptable in today's new economy as long as a company fits all the other CanSlim rules. Look for big volume increases when a stock begins to move out of its basing area. L equals leader or laggard. Buy market leaders and avoid laggards. Buy the number 1 company in its field or space. Most leaders will have relative price strength ratings of 80 to 90 or higher and composite ratings of 90 or more in bull markets. I equals institutional sponsorship. Buy stocks with increasing sponsorship and at least 1 or 2 mutual fund owners with top-notch recent performance records. Also look for companies with management ownership. M equals market direction. Learn to determine the overall market direction by accurately interpreting the daily market index's price and volume movements and the action of individual market leaders. This can determine whether you win big or lose. You need to stay in gear with the market. It doesn't pay to be out of phase with the market. is can slim momentum investing. I'm not even sure what momentum investing is. Some analysts and reporters who don't understand anything about how we invest have given that name to what we talk about and do. They say it's buying the stocks that have gone up the most in price and that have the strongest relative price strength. No one in her right mind invests that way. What we do is identify companies with strong fundamentals, large sales and earnings increases resulting from unique new products or services, and then buy their stocks when they emerge from properly formed price consolidation periods and before they run up dramatically in price during bull markets. When bear markets are beginning, we want people to protect themselves and nail down their gains by knowing when to sell and start raising cash. We are not investment advisors. We do not write and disseminate any research reports. We do not call or visit companies. We do not make markets in stocks, deal in derivatives, do underwritings, or arrange mergers. We don't manage any public or institutional money. We are historians, studying and discovering how stocks and markets actually work and teaching and training people everywhere who want to make money investing intelligently and realistically. These are ordinary people from all walks of life, including professionals. We do not give them fish. We teach them how to fish for their whole future so that they too can capitalize on the American dream. Experts, education, and egos. On Wall Street, wise men can be drawn into booby traps just as easily as fools. From what I've seen over many years, the length and quality of one's education and the level of one's IQ have very little to do with making money investing in the market. The more intelligent people are, particularly men, the more they think they really know what they're doing, and the more they may have to learn the hard way how little they really know about outsmarting the markets. We've all now witnessed firsthand the severe damage that supposedly bright, intelligent, and highly educated people in New York and Washington, D.C. caused this country in 2008. U.S. senators, heads of congressional committees, political types working for government-sponsored entities such as Fannie Mae and Freddie Mac, plus heads of top New York-based brokerage firms, lending banks, and mortgage brokers all thought they knew what they were doing, with many of them using absurd leverage of 50-to-1 to invest in subprime real estate loans. They created sophisticated derivatives and insurance programs to justify such incredible risks. No one group was solely to blame, since both Democrats and Republicans were involved. However, it all began as a well-intended big government program that was accelerated in 1995, 1997, and 1998 when the Glass-Steagall Act was rescinded, and things continued to escalate out of control. So maybe it's time for you to take more control of your investing and make up your mind that you're going to learn how to save and invest your hard-earned money more safely and wisely than Washington and Wall Street have done since the late 1990s. If you really want to do it, you certainly can. Anyone can. The few people I've known over the years who have been unquestionably successful investing in America were decisive individuals without huge egos. The market has a simple way of whittling all excessive pride and overblown egos down to size. After all, the whole idea is to be completely objective and recognize what the marketplace is telling you, rather than trying to prove that what you said or did yesterday or 6 weeks ago was right. The fastest way to take a bath in the stock market is to try to prove that you are right and the market is wrong. Humility and common sense provide essential balance. Sometimes, listening to quoted and accepted experts can get you into trouble. In the spring and summer of 1982, a well-known expert insisted that government borrowing was going to crowd out the private sector and that interest rates and inflation would soar back to new highs. Things turned out exactly the opposite. Inflation broke and interest rates came crashing down. Another expert's bear market call in the summer of 1996 came only one day before the market bottom. Week after week during the 2000 bear market, one expert after another kept saying on CNBC that it was time to buy high-tech stocks, only to watch the techs continue to plummet further. Many high-profile analysts and strategists kept telling investors to capitalize on these once-in-a-lifetime buying opportunities on the way down. Buying on the way down can be a very dangerous pastime. Conventional wisdom or consensus thinking in the market is seldom right. I never pay any attention to the parade of experts voicing their personal opinions on the market in print or on TV. It creates entirely too much confusion and can cost you a great deal of money. In 2000, some strategists were telling people to buy the dips, short-term declines in price, because the cash position of mutual funds had increased greatly, and all this money was sitting on the sidelines waiting to be invested. To prove this wrong, all anyone had to do was look at the general markets and sectors page in Investors Business Daily. It showed that while mutual fund cash positions had indeed risen, they were still significantly below their historical highs and even below their historical averages. The only thing that works well is to let the market indexes tell you when it's time to enter and exit. Never fight the market. It's bigger than you are.